It's been a year of unpredictability and massive readjustment for tech.
Tech is in the crosshairs.
Soaring inflation.
The country now faces prices more than 10% higher.
Supply chain chaos. Revolt in the gig economy. And an historic energy crisis have created uncertainty for consumers, workers, and businesses. Some investors, haunted by the dot-com bust, are bracing for bigger losses ahead. Hybrid workforces with less impact on the environment. And some companies are thriving. The question is, which ones? And how are they planning for the future? We bring together Europe's business leaders, policymakers, and entrepreneurs to reflect on a tumultuous period and explain how it's informed their crucial next steps. This is the Bloomberg Technology Summit.
Please welcome to the stage Brad Stone, author and senior executive editor for technology at Bloomberg.
Hello, everybody. Welcome to the Bloomberg Technology Summit. This is our first gathering since 2019 and a hiatus forced on us by the pandemic. So whether you're joining us virtually or here in person, we are so happy to see you. Over the course of the day, we're going to have a number of conversations about where the tech industry is headed in 2023 and beyond. We'll look at the tech investment landscape in Europe, the opportunities and challenges of AI, the Metaverse and Web3, and the tightening regulatory landscape around big tech. And we'll measure the hype against the reality. In every conversation today, we want to ask how businesses and innovation can thrive in an environment that's become so challenging with high borrowing costs, high energy costs, and a closed IPO market. You know what I'm talking about. The bad news seems to confront us every single day. We have an incredible lineup of speakers today, and we'll get started in just a few minutes. First, though, I want to thank our presenting sponsors, Ericsson, IBM, Mastercard, Autonomous, and the Zurich Insurance Group. And, of course, a couple of housekeeping announcements. For our virtual attendees, if you experience any issues with audio or video, please refresh your browser. This is what I tell my mother all the time, just restart. If that doesn't work, use the chat box in the bottom right corner of your screen to ask for support. We would love to hear from you throughout the day. Send us your questions and we'll do our best to include them in our conversations on stage. We'll also be polling you, and I hope you'll participate. So if you're here in the room with us, please scan the QR code that's printed on your badge. You'll be able to answer a poll or send in a question this way. And if you're joining us virtually, you can access the live polls by clicking on the interactivity widget in the footer of the live page. Q&A and chat functionality is on the right side of the live window. So let's do a dry run here. I'll give you a moment to get your phones out and scan the QR code. And I've suggested a question here to start us on our day. Which most closely matches your prediction for European tech over the next 5 years? I'll read slowly so you can log into the polling app. A shakeout is coming with declining valuations and many startups going out of business. That's just kind of a grim way to start the day, option A. B, there will be a few successes, mostly via acquisition by US giants. C, we're entering a new renaissance with new public companies and platforms created here in the UK. Or D, little changes. The tech community here looks the same in 5 years as it does today. So send in your answers. We get very rapid results, and we can see what mood we're in this morning and perhaps how much coffee we've had. I guess it may take a second. Here we go. Oh, you know what? A little bit of morning optimism, or at least something of a dead heat. But I like the idea that we're entering into a new renaissance. And we've all gotten the hang of the polling, so that's also good news. So please participate in the polls throughout the day. And remember to engage with us on social media using the hashtag BloombergTech. I'll be back later in the day, but that's all for me for the moment. Let's get started.
Please welcome to the stage Hermann Hauser, co-founder and venture partner at Amadeus Capital Partners. Tom Stafford, co-founder and managing partner at DST Global, and Julie Kainz, partner at Lightspeed Venture Partners, plus Bloomberg's Ivan Livingston.
Good morning, everyone, and thanks so much for joining us. We have an esteemed and very thoughtful panel of European venture capitalists this morning, and we're going to have a great discussion. And first, just because the VC market can be a bit opaque at times, I want to do a bit of unscientific polling, if you will. So we ran a Twitter live poll in advance of this panel to get a sense of how are people gauging the current slowdown in VC? So you can see I guess the leaders are a bit split, waiting until mid-2023 to the end of 2023 for the VC down market to last. So again, unscientific, but tells you people are expecting the current trend to continue. And then we're also going to run a live poll, as Brad demonstrated. So if you can all scan your QR codes, I guess, and if we can get it up on the screen. Again, just to kind of gauge, I guess, the gap between the US and Europe to set the scene for our discussion. So how far behind does the European VC ecosystem lag the US? Would you say there's no gap? Would you say it's a 1 to 5 years gap? Would you say it'll take more than 5 years for Europe to catch up to the US? And we should get some results. Okay, so the US is in sight. So 2/3 of people saying 1 to 5 years. Sounds about right. Great. All right. Well, thank you all very much. And now I want to turn to our panelists. And I think the first question, again, just to kind of set the scene, if you could all just talk a bit, maybe starting with Tom and then going down the line. How has your investment activity changed this year compared to last year, and why?
I mean, I'd love to say that we are consistent year after year and nothing changes, but that would be very far from the truth. In reality, our dollars deployed this year is running significantly below last year, but even significantly below our our lifetime average. We're about 12 years old as a firm, and we're way below the average. There are a couple of drivers of that. Of course, we are at the end of the day, driven a little bit by the spirit of an industry and the spirit of our own performance and our portfolio's performance and our company's performance. And anybody who sort of denies that it's got anything to do with how you feel in the morning when you wake up is full of BS in my view. So there's of course a sort of an emotional aspect to this, but there's also a kind of a technical part to this, which is so many companies in our ecosystem raised 2, even 3 times last year, and the deal sizes last year were way larger than normal. They were anything within 30 to 80% larger than the normal deal size. Therefore, companies are quite flush with cash actually leaving last year. So most companies, and particularly most good companies that we all want to be investing in, didn't need to raise this year. And so when you look at the statistics, there's actually very few deals in market, let alone getting done. And so I would say our deal pace is significantly lower, driven by this emotional aspect, of course, but primarily by just the amount of deals in the market. There's just not many, because most companies are trying to avoid raising this year if they possibly can, which is a mistake in my view, in the hope that next year is better than this year, and that they will therefore raise next year, which is a pretty significant mistake, I think.
Yeah, maybe to give some context, so Lightspeed is a fund that invests across stages. So we invest from seed, super early, founding team just starting, up to pre-IPO growth stage, essentially. And I think you see quite a difference between the two teams and the different funds in terms of pace right now. Early stage is still quite active on our end, and I think especially sort of seed deals, Series A has been very slow, but seed deals have been happening. mostly because founders are still going out, especially the ones that are really, really have high conviction in what they want to build, despite a recession looming, despite what they see in the market. And actually that's very exciting because the founders that come in the market now, they are really behind what they're building, and they're usually really, really high quality. On the growth side, however, it's exactly what Tom said, basically. It's very hard to find companies right now that are best in class and that want to raise in this environment because they usually have a lot of cash already. And then secondly, it's really hard to price. So we really struggle to sort of readjust to the public market expectations of the founders, what we think is the right point. There's been a bit of calibration as well over the last months. And I think that hopefully by possibly end of the year, start of next year, we'll get a bit closer to that point where we can have those conversations. But it's been quite slow on the late stage as well for us.
Well, clearly we are in a recession, and a recession affects every sector in the economy, including venture capital. Having said that, at Amadeus, we're a deep tech investor, and we're probably least affected by that because deep tech is much longer term, and there are a few encouraging long-term signs. Having been in this industry for some time, I've seen 4 of these cycles, and the story is always the same. First of all, people have to concentrate on cash, and as Tom already said, many of the companies have been very fortunate to raise quite a bit of money during this fantastic cycle that we've just been through. The second thing to note is, for the first time in history, European venture capital is giving better returns than US venture capital, which is, again, a good long-term sign. But then there is also the correlation that, of course, investors have known for a long time in this space, that if you invest in a venture fund, a new venture fund during a recession, there is actually a great correlation between the vintage year in a recession and the positive return that you can get. And the same thing is true for venture investors, venture companies themselves. So a recession is actually a very good time to start a new company for, in a way, obvious reasons. You have got access to a lot of talent because during a recession there are more highly qualified people available, and for venture capitalists, of course, the valuations are more reasonable during a recession. So this is not necessarily a bad period for venture capital.
Yeah, I think our conversation is coming at a very interesting time because already this year it was quite an uncertain macro outlook, and then the last week has brought even more rattles in the market and changes, especially here in the UK. And so maybe we can I guess reverse the order and starting with you, Hermann. How are you I guess viewing the macro outlook, and what are you advising the entrepreneurs that you work with in the current storms?
Well, the macro outlook clearly is that we're in a recession, and the recession will probably last, a year or two. It's very difficult to predict at the moment because there are so many imponderables that bear on the development. The UK in particular is in this very stormy period of having a financially undereducated chancellor who goes by neoliberal ideology rather than rational decision-making. So that doesn't help. But sooner or later, he'll probably do a U-turn and come to his senses again. When you look at Europe as a whole, the way I see the situation is that if you look at European tech, if Silicon Valley is there, the UK is here, Europe is here, and my native Austria is there, then the gradient used to be very steep. The order is still the same, but the gradient is much shallower. I think a lot of the environment in the UK is now closer to Silicon Valley. But don't underestimate Europe either. Europe is often treated as the sort of lumbering consensus giant. But we've got very vibrant tech communities in Berlin, in Munich, in Paris, in Helsinki. So Europe is snapping on the heels of UK as the leading a venture company, as indeed many people, partially because of Brexit, especially at our universities here in Britain, are leaving and going back to Europe. So the fact that the order is still the same, but the gradient is much shallower, can also be proven by Austria. Even Austria, my native Austria, and I run a summer school there, I've been trying to help Austria catch up with the rest of Europe. Even Austria has 3 unicorns now, so it's even trickling down to the very east of Europe.
Actually, Hermann made an interesting point at the beginning about not being sure how long the recession will last, and I think that's an important point that we've been telling founders a lot. So I think there's an interesting game that you need to play. On one side, you don't want to slow yourself too much down, so once the opportunity comes back up, you haven't completely depleted your go-to-market team, your product development and whatnot, and you kind of don't have the chance to catch up again and ride basically the next wave of upswing again. But on the other hand, I think it's really important for especially young founders, first-time founders that haven't been through a recession yet. We often see them thinking that this is going to last until maybe end of this year, maybe mid next year, and then it's going to be fine again. No one knows really. And so I think preparing yourself to make cuts that could be potentially deeper than anticipated, I think is also mentally something that is important. And so I think what we're trying to do is also connecting those founders with founders who've been through this cycle before, who've done this before. It's a challenging time mentally and emotionally, right? And so sometimes it's also better to prepare yourself a little bit more drastically right now versus making 1,000 cuts over a few years, basically, which is going to be more dramatic, I think, to culture, to the company as a whole. So I think just anticipating that this might last longer than we expect initially is I think what we keep on telling the founders. Yeah,
to be honest, I'm also trying to say that let's not focus on the macro at all. To a certain extent, albeit that is a very simple statement to make, we invest globally with a large portion of our capital deployed into places like Brazil, Colombia, Mexico, India, Indonesia over time. And for some of these countries, they were in incredibly difficult and continually difficult macro conditions whilst US, Europe, et cetera, were booming. And yet great companies got built there. One of our portfolio companies called Nubank was built in Brazil at a time from when we invested till now where the currency depreciated by roughly 80%. And yet they built hopefully a $50 to $100 billion company, I think trading today at more like 25 billion. But if you think about that company, macro was completely against them, but to a certain extent, they exploited that. They exploited the fact that the existing incumbent banks were not investing in their branches, were not investing in their product, were not investing in their customers. They exploited the fact that there weren't sort of great jobs for people emerging from STEM education in Brazil, and they took those resources, i.e. the opportunity within their category within banking, and the resource of talent, and they built a fantastic company in a very lean way, a very low capital intensity way, which in banking is not easy to do. So actually what we're trying to say to our founders is, think about what builds a great company. There's basically 3 buckets of resources. There's the idea, and within idea you need drive and motivation. We all have ideas, but actually following through on them is a big part. So the idea and drive and motivation. There's capital, and there's talent, the people to go and help you build this thing. The first one, as Julie actually mentioned, there's always lots of ideas, and generally speaking, there's great people with motivation to go after them. On average, there's 12,000 to 13,000 seed deals per year, globally. 12,000 to 13,000. And that doesn't really vary that much. This year will be lower, but it doesn't really change very much. If you look back over like 10 years of history, it's relatively consistent because people with ideas, people with motivation are there. What changed in the last few years is this amount of capital. So this resource bucket of capital changed dramatically, but at the expense of too many of the ideas getting funded for too long, when instead those great people should have recycled back into the industry with better ideas, and at the expense of the talent bucket, because the talent was getting spread like very thin jam across the entire industry, and being incentivized to switch to keep hopping. Like all of us will have our statistics within our companies. Employee retention collapsed over the last few years because it was very hard if you were earning X and Google comes along and says, oh, here's 5X. And 5X sounds crazy, but that is the statistic at one stage in 2020-21. Google and Facebook were approaching employees of our companies at 5 times the salary. Even for people who are very dedicated to a cause, a 5-time salary bump is not easy to say no to. So when we talk to our founders, to cut it short, ideas are great and always there. Capital is needed, but actually talent is the most important thing. And this adage that comes out of Silicon Valley of many years of do more with less is sort of a bit of a synopsis or a simplification of talent can overcome lack of capital. And so we're actually super excited about this time frame because we think the best companies will rise to the top. They will be able to get the best talent, and then eventually capital will flow to them. There's loads of money around. It just needs to find those best companies. And so we're actually, to be honest, quite thrilled with the kind of the current state of the VC market. It's much healthier now than it was 1 year ago, far healthier.
I think Hermann had a point you were hoping to.
Yes, I wanted to make some comment on these American monopolies, the GAFA, Google, Amazon, Facebook, and Apple, just scooping up the talent and sometimes also scooping up the companies in areas that aren't even core to their main mission anymore. So I'm just writing a book on technology sovereignty of how these dependencies that Europe is beginning to suffer from just because of American monopolies and the sheer financial power that they have so that they can pay 5 times the salary if they really want to build up AI capability, or now in quantum computing, where I spend a lot. I've made 7 investments in quantum computing. If I look at who finances quantum computers at the moment, it's in the US, we've got 2 or 3 companies that have now raised over $500 million. PsiQuantum, which we're also a small investor in, Ionic, both have raised 700 and 600 million. We have great government support in Europe for these companies. We've got 2 billion in Germany, 2 billion in France, 1 billion flagship project. But as Tom said, we do not have a startup problem in Europe. We actually produce more startups in Europe than the US. We have a scale-up problem. When we have really good ideas and the companies show that the new product, that the new idea does actually work, we don't have the financial firepower to then put hundreds of millions behind this company to make it a global leader. So that's, I think, our main problem that we have in Europe.
Yeah. I mean, one point I want to follow up, Tom, you said something very interesting earlier about it being a mistake to hold off on raising this year in the hopes that things will turn around a bit. And one of the issues that I've heard about from other investors is like the idea of the bid-ask spread still being too wide. Founders have this expectation that they can raise money at a valuation last year when the market has changed a lot this year. So I'm curious, how is that, are you seeing that spread narrowing at all? And one of the audience members has asked, if VC debt might be part of the answer this year for companies that need funding as markets cool. So are you seeing that spread narrowing, and is debt more part of the answer this year?
I think it's still quite a mixed picture, actually. So I still see both happening. There's been, over the last few weeks, actually still rounds happening at multiples that were more last year, so 50x, 100x current ARR. So some of the best founders and best assets out there still can do that. However, on the other side, I'm also seeing companies now going into flat rounds, actually, to beef up the balance sheet. We see more convertibles happening that kind of defer the pricing conversation a little bit, but add a little bit of cash as well. So I do think structure is coming as well, more and more. I've not seen any of that the last 2 years, actually, and we've seen it in a few rounds now, especially later stage. So I think there's definitely some interesting stuff happening there. And I do think it still takes a little bit of time to reset. But I think founders are becoming are being more open now to having that conversation and seeing what makes sense. But it's still on both ends. So it's not, I think, one unified picture at this point.
Yeah, I'd say that the answer is no. I think there's still a lot of naive thinking about where companies are at. And it's not helped by the shareholders of companies, and I'm sure people would accuse us of the same thing, thinking that their own companies are amazing. In reality, we could all sit here and really think back over the last 20 years, how many phenomenal billion-dollar companies have been created. And by billion-dollar companies, I mean viably billion-dollar, with 50 million plus of profitability at some point in the near future. There's actually not that many. And that's kind of makes sense, right? It shouldn't be that easy to produce billion-dollar companies, right? This is hard to do. Produce a company that customers want to pay you for your services, whether it be a software service, whether it be for a computing service, whether it be for the delivery of goods, for the delivery of food, for financial services. It is not easy to build a billion-dollar company. Yet, if you look at this kind of silly moniker of the unicorn, I mean, it was like the last 5 years was like unicorns were just being bred as if they weren't special. But when I read my sons and daughters books at home, unicorns are these mythical special things. They don't seem very special with the hundreds of them being printed right now. But to be honest, that's all BS. They're not real. A company is real when it has a viable technology that nobody else has, and/or viable profits that are defensible that nobody else has. And most of the companies, just very bluntly, in the VC ecosystem are not in either of those two camps. And so there will be thousands of companies, thousands, that need to go out of business between now and the end of 2023. And everybody's going to be shocked about that and appalled by that, and there'll be weeping and gnashing, and all the great blogs and publications will write about this. But this is perfectly normal. This is what the system's supposed to be. It's a very fat bottom of the pyramid, 13,000 seed deals a year, feeding up through. The companies make it or don't make it. When they don't make it, it's sometimes they've actually got a great technology, but they can't fix go-to-market, so they get bought by somebody else, or they merge with somebody else. Or the idea didn't work, but the team is fantastic. They cycle back into the industry. And this fat bottom of the pyramid gets to the very top, small of the pyramid. Whether it should be a couple of trillion-dollar companies, who knows, that maybe isn't that healthy either. But realistically, the majority of ideas don't make it to the top. And we just have not seen that for the last few years, because almost every company could raise capital for the last 3 years. Almost without fail. Didn't really matter if your idea was amazing, not amazing, traction, not traction. It's 10 other companies in your space, 100 other companies in your space. That will change. And until that changes, it also means that people are going to hold on to their companies. You see a lot of convertibles, a lot of internal rounds being done. A lot of like, oh, well, it's okay, we'll figure it out. And that's kind of normal. Again, it's an emotional business we're all in, right? Everything to do with making decisions is emotional at the end of the day, at least partly. And so we just need for that to wipe out over the next 6 to 12 months. And then rationality will feed in, and that's wonderful. Not every company should make it. There's no problem with that. We should embrace failure. It's not a bad thing. Failure means we tried, we recognized that it didn't work, and we moved on to the next thing. That's healthy, and I think that hasn't happened yet.
I think one of the issues in Europe, there are so few successful companies that make it to that point. And then there's the question of if they're able to stand on their own feet as a public company, do they list in the US? Do they list in Europe? Slightly before that stage, is there late stage growth funding to back those companies? So I was curious to ask this panel as well. Should there be more of a push to keep later stage companies in Europe, and if so, what needs to happen for that to materialize?
Well, this is the big question of technology sovereignty, which all of a sudden has become an iconic issue for this decade. And one's got to be very careful to distinguish between not wanting to have a globalized industry, which clearly would be a bad decision. It is good that there is the option of selling companies to the Americans and maybe sometimes to the Chinese, as long as there is a reciprocal arrangement that European companies also buy American companies, because as Tom already hinted at, Darwin was right. You know, you've got to let evolution work on a global scale. However, there is this issue of dependencies. So when technology sovereignty becomes an issue, is if a country becomes dependent on a critical technology. By critical technology, I mean a technology that's necessary for a government to run its country properly and for economy in a country to work properly. These critical technologies, for example, are the semiconductor technology. That Trump managed to use the American dominance in silicon design software with Synopsys and Cadence. Synopsys and Cadence have a 90% market share in silicon design software worldwide. He managed to use this in a sort of extraterritorial power that he has by turning this monopoly into a weapon, this technology into a weapon to force other countries, including Britain, to do what he wants. Now, these dependencies are as severe now as military occupation was in the past, and we just have to find our own independent access to critical technologies. So every nation now has to ask itself 3 questions. Question number 1, do I have all the critical technologies that I need to run a country and its economy? Do I have it myself? In which case, we're fine. And of course, the answer for Britain, for example, has to be absolutely no. There's no chance in hell that Britain could ever become technologically sovereign. The second question is, do I have access to these technologies from multiple independent countries so that there isn't a single country that can coerce me to do things that I don't want to do? If the answer to the second question is no, you've got to ask the third question. Do I have unfettered, long-term, longer than 5 years, access to monopoly or oligopoly, typically from the US or China? And if the answer to all 3 questions is no, then we have to do whatever it takes until you get at least one yes. Because if not, you accept this dependency on another country, which in my opinion is just as severe as military occupation in the past. So there will only be 3 technology sovereignty circles in the world, the US, China, and Europe. And I very much hope that despite Brexit, of course, Britain will side with Europe and help together with Europe to build the third option that we have in the world.
I just add to that, by the way, it's really interesting to think about that sort of deep tech side of things, as you always do, Hermann. But there's also a point about sort of economic sovereignty, which is if Europe keeps seeding its best graduates or its best ideas to other parts of the world, and think about the number of French and Italian and Irish and Germans working in Silicon Valley. It's a huge number, right? And we know that 50% plus of sort of entrepreneurs in the Valley in Silicon Valley are immigrants. If Europe, and indeed India, Southeast Asia, Latin America, et cetera, keep seeding the best kind of company builders to the US and to the US capital markets, not only do we have to worry about sort of our technological sovereignty, but also our economic sovereignty. The fact is, from where I sit, which is obviously a very small part of the sort of the capital markets, Europe has ceded its capital markets to the US. Completely ceded it. Our companies in Europe, our public companies that we hold in Europe, on average trade between 1% and 2% of the average daily turnover of our US comparables. That's adjusted for market cap. There's no trading of our companies in Europe. We have a couple of 2, 3, 4, 5, and they were at one stage $10 billion market cap companies here in Europe that trade anywhere between 500,000 and 2 million, not shares, but euros and pounds equivalent per day. I hold stakes in some of these companies of 500 million, a billion. I mean, the math just doesn't make any sense. How can I, as a fiduciary for my limited partners, encourage my companies to go public in a capital market that just basically doesn't work? It's more complicated on the regulatory side, it's longer winded, there's no research coverage, and then when you finally do go public, there's nobody trades your shares. Or we could take a 6-hour flight to New York, be warmly embraced, and indeed encouraged, made very easy to go public, huge research coverage, not always very sensible research coverage, but huge research coverage, and average daily trading volumes that are multiples of what we see in Europe. So if we think about technological sovereignty, very, very good point that Hermann's making. I'd also just say Europe is in very big jeopardy of becoming economically and capital markets-wise dependent on the US capital markets. And by the way, from what I can see in the debt capital markets, it's exactly the same thing. You look at what's happening in options and derivatives, the same thing. I mean, think about the great option derivative houses of the last 20 years, SocGen, et cetera. They're not in that market really anymore at all. All those derivatives being created, FX, inflation, interest rate, they're all being driven by US capital markets houses. And so where I look at today is a technological problem, but also a ginormous economic problem. And more regulation is not going to help us get out of this. We need to figure out, first of all, how do we have a healthy, functioning capital markets? Because that's the core of all economies, and it does not function in Europe today.
Well, thanks very much. I'm sure we could talk much longer about this, but for the sake of all the panels after us, I think unfortunately we have to wrap up. But thank you for a great conversation, and thanks as well to you all for the questions and the polling.
As the line between the real world and the digital dissolves, cyber and intelligence is at the heart of securing both. By developing technologies that align convenience with security, we're enabling individuals and societies to prosper together. We're looking ahead, securing consumer trust, pioneering innovative platforms, and expanding into new sectors. An exciting path lies ahead. Together, let's make it happen.
Please welcome to the stage Ajay Bhalla, President of Cyber and Intelligence at Mastercard, and Bloomberg's Lauren Keel.
Good morning, everyone. This would not be a true tech summit if we did not have some hybrid conversations for you. So I am here with you in person in the room. Ajay is joining us virtually. You should see him right behind me on the screen here. So really putting the technology to work for you guys first thing this morning. Ajay, thank you so much for joining me.
Hello, Lauren. Good morning, and thank you for having me here. I wish I was there in person, but you're right. We are making the best use of technology.
Exactly. You actually have a fascinating job. You're leading cyber and intelligence for Mastercard, especially at this time of immense challenges, you know, to put it really bluntly. So I'm really curious, what is keeping you up at night right now?
Well, a lot of things are keeping me up at night, as you can see from newspapers currently. But technology is advancing rapidly, and you know, as a result, we are seeing a number of strategic trends that are shaping the world around us. I would say the key big things which we are really keeping track of, I think the first key big one is connectivity. I think the world has never seen this kind of connectivity before. And the convergence of the physical world with the digital world, with the IoT, with 5G kind of connectivity available now, pretty much all pervasive, that's almost creating an invisible integration and use of technologies in our everyday life. You know, billions of devices are already connected to IoT, and you know, it's predicted that more than 75 will be connected. 75 billion will be connected by 2025, which is going to bring a lot of new opportunities. Now, these connected devices and networks is creating exponential growth in data, and this data then creates powerful new level of personalization, but it also means you have to protect and you have to keep this data safe. And then all these emerging new technologies with AI, blockchain, quantum, cloud, digital assets, again, they're changing the whole ecosystem. Again, we have to make sure that these are all secure and safe. So as a result of these changes which are happening in the world, cybercrime is now almost a global industry. And the cost of cybercrime is almost expected to reach $10.5 trillion by 2025. Like, that's a mind-boggling numbers. And I'm sure everybody here reads all the breaches and all the hacks which are going on. Everyone sees that every day. So it's never been more important that we innovate and create solutions to keep consumers safe, to keep their data safe. And really, that's my role. And we are using all the advanced technologies like AI, quantum, cloud, 5G, which I spoke about earlier, to make sure that no matter where you are, physical world, digital world, that our consumers and customers can enjoy a seamless, safe, and secure experience. Long answer, but I think I needed to do that setup.
Great. You mentioned a couple of different technologies, and I want to pull out one of them in particular, which you mentioned is AI. How are you using AI to make payments safer?
So it's a great technology which is fueling development and innovation in the same way as nothing else has ever done. And AI has been around for a long time, but I think with all the technology changes, I think this is now actually really helping the world, from predicting weather patterns to food supplies to helping diagnose disease. It's really helping progress our society. Now, we have been at the forefront of AI, applying the technology in almost every aspect of our business. So we really use it for predominantly, I would say, three things. First is to really safeguard the whole ecosystem. I spoke about that earlier. And in fact, our AI-powered solutions have saved $30 billion in fraud in the past 2 years. Second is to really enrich the digital experience which consumers can use and can benefit when they are buying, when our customers are selling, because these superior digital experiences can be created with the help of advanced AI. And the third piece, I would say, is to really help improve society. So we invest in the future of AI to really understand and help solve society's most pressing challenges. And we apply AI responsibly, ethically, putting really individual interests at the forefront of our practices.
I can imagine most people here, like me, want to pay for things as quickly as possible, as safely as possible, as easily as possible. We're used to tapping now. We want things to be instantaneous. So how are you seeing the challenges that you're facing on the security and cyber side evolve with the pressure that your consumers are saying we want it to be as easy and fast as possible?
And that's about it. It's about the consumer and what the consumer wants. So like I said earlier, we are living in a time of unprecedented connectivity. And, every hour, millions of digital interactions are taking place that require verification, that require authentication of identity, because the seller needs to know who you are. Are you the right person? Are you a legitimate person doing the transaction? And it's to protect consumers as well as the sellers. So whether you're shopping for groceries or a new car or in the physical store, we are using technology behind the scenes to make sure that you have the most intuitive experience that you want. And drawing on identity verification data, artificial intelligence, fraud prevention programs, our identity services really help our customers confidently know who they are at the other end. Because remember, in the physical world, people can see you. In the digital world, they really can't. And that's where all the technology solutions come in. And, we've got advanced solutions that can actually detect how you hold the phone, where you are you actually the legitimate person doing the transaction. And, with biometrics coming in, just imagine how many times all of us use biometrics in a single day to unlock our phone, to make our payment, to open an app, or even to enter a building. And so we've combined all these technologies, physical biometrics, fingerprint, face, palm, and have even created an experience of biometric checkout, which is going to transform the in-store payment experiences too. So when you shop in physical world, visualize, you'll be able to, just walk out at checkout through a facial recognition technology linked to payments. And we have now pilots running around the world to do that. So I would say we won't stop there. From, family-run merchants to fintechs to banks to governments and individuals around the world, we believe that innovation in payments has the potential to improve the business and lives for everyone.
Ajay, in our last 30 seconds together, we're going to be talking a bunch for the rest of the day around new and emerging technologies. So what's one new or emerging technology you're particularly excited about?
So I would say it's a combination of technologies which will really help. But I would say 5G, quantum, cloud, IoT, all of them I mentioned. But our work, for example, on enhanced contactless, and I'm sure everybody uses contactless, is an industry first in its security, is 3 million times harder to break. And this helps ensure that as new technologies like quantum computing are introduced, contactless technology is future-proofed to ensure consumers will continue to enjoy the same level of security and convenience that they do today, and for decades to come.
Fantastic. Ajay, thank you so much for joining me.
Thank you, Lauren. Thank you for having me here.
Please welcome to the stage Frederike Kaltheuner, Director for Technology and Human Rights at Human Rights Watch, Poppy Gustafsson, CEO of Darktrace, and Thomas Siebel, Chairman and CEO of C3 AI, with Bloomberg's Olivia Solon.
Hello. A few years ago, a venture capital firm, MMC, surveyed about 2,800 European startups that claimed to use AI and found that about 40% of them weren't using any machine learning at all. So how should investors, and journalists for that matter, interrogate claims made by companies that say artificial intelligence sits at the heart of their business? It's not just about whether a company uses AI as claimed, but also whether AI tools are being applied to complex societal problems they simply can't solve, or they've been built in a shoddy way that encodes biases and inaccuracies. At a time when AI hype is at an all-time high, with generative art tools like DALL-E spawning news reports decrying the end of the creative industries, and at least one Google employee very publicly falling for an AI chatbot, how can we attempt to sort AI fact from fiction? What due diligence challenges do AI startups present to investors and customers? What can companies do to show off their true capabilities? And are there any obvious hallmarks of AI snake oil? Now, to answer some of these questions, we have a fantastic panel of experts, and I know you've been introduced to them by name, but I'm going to invite them to just very briefly explain a little bit more about their company and their role before we get stuck into what I hope will be a very lively discussion. So over to you, Tom.
Thank you. My name is Tom Siebel. I'm the Chief Executive Officer of a company called C3 AI, and we are a enterprise AI application software company where we apply AI to business processes at kind of very, very large commercial and industrial scale in telecommunications, manufacturing, oil and gas, utilities, financial services, what have you, to bring precision health, to bring a significant social and economic benefit to those enterprises, their customers, and the community at large.
Frederike.
It's very nice to be here. I'm Frederike Kaltheuner. I run the technology division of one of the two largest human rights organizations in the world. And I always say, I'm in the business of dystopia. We, on the one hand, use technology to investigate grave human rights abuses, but at the same time, increasingly we're seeing that technology itself plays a growing role in human rights abuses around the world.
Okay, and Poppy.
Hello, yes, so my name's Poppy, I'm the CEO at Darktrace. So Darktrace is a cyber AI company, and we're using artificial intelligence to protect businesses from cyber attacks. And today, every second of every day, we are using that technology to interrupt an in-progress cyber threat.
So I'm going to start with a question that I want all of you to answer. There's always been a culture of fake it till you make it within startups. And I'm curious whether you think there's something different happening here with regards to AI systems. And let's start with Poppy.
I think, first of all, AI, I think, is an essential component of future innovation. And I think the fact that you've got so many businesses claiming to use AI is symptomatic of the fact that we get that AI is going to be a really important force for the innovation over the coming years and decades. So I think AI is at a point now where it is essential to any sort of future development. But it is also becoming a little bit of a buzzword, as you say, and there is a bit of I remember chatting to you about, I saw an ad of a toothbrush that was claiming to use AI to brush your teeth, and I thought, I'm a little bit skeptical about whether that is true or not. But it's an emerging technology. It's something that people don't necessarily always understand, and technology is really difficult to describe. At Darktrace, we always have a mantra of show, don't tell. So it's not about us saying, hey, look what we're doing using AI, and let me have a conversation with you about our algorithms and how that can defend your business from cyber attacks. It's saying, let me show you my technology. For no money, I am going to go in, install my technology in your business, and show you what it can do. And I think that becomes a really compelling way of showing it in real life on real data systems. Because sometimes you get AI that's set up in a laboratory environment with perfect information. It's all geared up a particular way to find a particular thing. Working in the real world is a very different case altogether.
Frederike, what do you think?
I think there's a reason why we're talking about AI, and the reason why we're talking about AI is that the technology has made significant and impressive progress over the last few years. But that progress is limited to solving very narrowly defined, very specific tasks. And what's happening, and in a way we're all complicit, the NGO world, journalism, investors, is that real and imagined gains are being conflated. It's gotten a little better, is my sense, but for a long time, I think pre-pandemic was the peak for me. Not a day passed by without some news article, some academic paper making incredible claims about the capabilities of AI. Just to throw some at you. AI can solve world poverty. No, it cannot. AI can detect whether you're gay or straight from your face alone. It cannot. AI can detect people's ethnicity and race. AI can be used as a lie detector at the EU border. And the frequency with which these claims were made, the problem is it's bad for businesses, it's bad for government, because AI is sold to solve problems it cannot solve. But it also results in real and tangible harm, and that harm affects some people more than others. At the border, if you're not a white person, so I think that's why the discussion really matters.
As much as I would like to go to deep on Frederike's subject, which I think we'll get into later, we'll talk about the hype factor in AI. And the hype factor in AI, I don't think it's reached its apogee yet. This has a way to go. And so every company now, technology company, has decided that they're a leader in AI. Every company's decided that they're a leader in quantum computing. I mean, honestly, with all due respect, guys, this is all complete poppycock, okay? Now, let's take an area that's existential, where Poppy plays in cybersecurity. I mean, this is really existential. And if any of you have read a book called The Perfect Weapon, if you haven't read a book called The Perfect Weapon by a guy named David Sanger, I strongly recommend it. But it's basically a history of every state-sanctioned cyber attack that's taken place since, starting with Stuxnet, which maybe the US did with the Israelis, and ending with SolarWinds. But all of these cybersecurity companies all of a sudden magically have become AI cybersecurity companies. Now, Darktrace happens to be probably the only legit one, okay? And the rest of it is just complete poppycock, because AI is important. They've said, basically what these guys have is databases of known strings, okay, wanna cry and what have you, and they're doing database lookups on the way, as the string comes through the firewall. Guys, this is not AI, okay? Now, so I think you have kind of maybe one exception and another, 200 cybersecurity companies that claim to be an AI, and it's complete and total not true. How about that for toning down my language a little bit?
Now, Poppy, Darktrace has been the target of criticism. I know it's been largely stoked by a short seller, but the criticism says that you're overhyping your product's capabilities, and some customers have allegedly characterized it as AI snake oil. How does a company like Darktrace respond to criticism like that and try to showcase your product's true capabilities?
I think much as it's deeply irritating to hear this sort of unfounded criticism, it's the nature of being a public company. We became public 15 months ago, and there's people that love buying your stock, and there's people that want to make money on the other side, and that's completely legitimate. We'll leave that to them. But the thing that I always come back to is, we have 7,400 customers. That means there's 7,400 CISOs and CIOs that thought, I want to see Darktrace working in my business and demonstrate its value, and then I'm going to part with the hard-earned cash that this business has generated to buy that technology and keep hold of that technology, and that's a sort of key indicator for me.
Okay. With the technology currently available, what kinds of problems are AI systems good at solving? I know Frederike has talked about some of the ones where they can't work, and where do they not work so well? How do you draw that line? Tom, let's start with you.
I think you can look at the world of AI as divided into three parts, kind of like Caesar divided Gaul into three parts. You have AGI, which is artificial general intelligence. This is kind of this deep mind idea that we're going to develop computers that have the capacity equal to or greater than human beings. And the dark side of that is when your smart refrigerator takes over your house, or HAL for 2001. And I don't think you need to worry about that, anytime soon. I mean, the smartest computer, largest computer setup that I'm available in the world might have the mental capacity of a mealworm. Now, it's true that we could have AI that can play chess better than a human being, or play Go better than a human being, maybe bake a cake better than a human being. But the problem is developing a computer that can play chess, play Go, drive a car, and write a novel better than a human being. Ain't gonna happen anytime soon. Okay, now the second largest application of AI today is in social media. Now this is very nefarious because we have figured out how to manipulate people at the level of the limbic brain. So limbic brain is that part of the brain that we have in common with a lizard. Okay, it evolved about 200 billion years ago, and it deals with the stuff of survival, like food, water, sex, and it releases a neurotransmitter called dopamine. And these guys have figured out how, that every time this buzzes, you get a release of dopamine. Every time somebody likes your photo, you get a release of dopamine. And, we have, 2 to 3 billion people, addicted to this technology, and it's a public health hazard. It's causing, major public health problems, particularly in young women. Depression, suicide, 1/3 of these people have body image issues. I mean, it's a horrible, horrible problem. So there's social media. The third is kind of the more mundane area where C3 AI plays. So C3 AI plays in the area of applying machine learning, kind of traditional, now well-developed AI techniques, big data fusion, and then machine learning to business processes where we can improve product availability, we can reduce failures, we can optimize the supply chain, we can make it so a company like Shell today, this would be $2 billion a year. LyondellBasell, a chemical company, this is $1 billion a year. United States Air Force, in terms of increased availability of aircraft, it's billions of dollars a year. So those are kind of the three areas of the way that we look at AI, and we tend to focus on those that are kind of business-oriented and highly ethical, because there are some, you face this litmus test of kind of crossing the line into unethical opportunities with AI every day. And I know Frederike is going to go long on this, but it's really, really troubling.
Yeah, we'll come to that. I think, Frederike, on that note, let's ask you, what are some of the problems that can emerge when AI is applied to social issues?
So I think, as I said, AI is very good in solving narrowly defined tasks, but there are some tasks that are fundamentally dubious. And one of these is predicting the future, predicting social outcomes. So who's going to drop out of school? Who's going to be violent when I arrest them? So this is a category where simple regression models, the reality is simply so complex that we're not really seeing. We do not have evidence that AI is really better at making these predictions. So that's a category. But what are the consequences? The consequences are that predictions have real-world consequences. If you are being flagged as an unreliable staff member, as potentially violent, that changes how people interact with you. And again, there are contexts like the workplace where this can lead to discrimination and harassment, but the areas where we work in, disasters, war zones, the border, this suspicion or being flagged as aggressive, deceptive can really harm people's lives. And I think what's so insidious about this is we are increasingly surrounded by systems that make assumptions about who we are. And the burden of proof falls on us to then correct these systems to say, this is actually not who I am. But we're dealing with systems that are inaccessible to those who are affected. And even making that statement or proving that you haven't committed fraud, you haven't lied, you're not trying to, I don't know, cross the border illegally can be a real burden. So this is, I think, one really big category. And the other one that's important is, even in a seemingly more mundane context, we see a lot of sloppiness with which AI is being deployed. But we can talk about this later.
Sure. Poppy, with Darktrace's technology is looking for anomalous behavior within an organization to try and find cyber threats. But within that, there could be occasions when your technology is kind of pointing to an individual to suggest that maybe they need to be investigated. Are there any ethical concerns that come about with that?
I think AI is brilliant at augmenting the human in the system and supporting the human in their job. And AI isn't used, I don't think, and it shouldn't be used to give a definitive answer. It's not saying, I'm a maths graduate, so apologies for the slight maths, but it's not a formula. Here's some inputs and there's an answer, and it's de facto this answer. It's much more of that sort of algorithmic, constantly reassessing. There's a whole ton of information, and across all of these bits of information, probabilistically, this is the bit that you should pay most attention to, or these are some areas of expertise. And I always liken it to when you meet a friend for coffee, and you sit down and say, how are you? And they say, yeah, I'm fine. But you think, I don't think they are fine. It's the tone. They've not brushed their hair. They've spilled coffee on themselves. Whatever it is, there's lots of little indicators where you think, you know what, I don't think they are fine. And that is what AI is really good at, digesting a whole bunch of information and then intelligently saying, probabilistically, these are the key things that you should be spending your time on. So for us, in terms of cybersecurity, to your point, it will be saying, hey, business, these are the top 3 things that right now look most unusual given what we're used to, the kind of behavior that's happening within your organization. If you're going to do 3 things today, investigate these 3 things. What they're not doing is saying, Bob in HR is a fraudster and you should fire him immediately.
Tom, do you agree with that?
Well, I think that this invention of AI, this is a big technological advancement. And when we look at the intersection of technology and sociology, there have been some unintended consequences that have been highly deleterious of some enormously positive inventions. Let's look at the 15th century of the Gutenberg press. Okay, now we can print the Bible in multiple languages. Okay, people can learn to read. We don't have to only go to the Pope or to the monk to figure out what's going on with, in heaven. Well, I mean, think of the consequence of the Gutenberg press. I mean, that obviously is a big deal, and it changed all our lives for centuries. But you can draw a direct line between that and the Reformation, 100 years of war, 30 years of war. I mean, there was nothing but wars in Europe for like 200 years, right? Ending with the Treaty of Westphalia. let's look at the steam engine and the Jacquard loom. I mean, I would argue that these are positive events. I think the Industrial Revolution was a good thing. Okay, that being said, you can draw a direct line between, between the invention of those technologies and Dickinsonian Europe, child labor, labor unions, Marxism, communism, World War I, World War II.
Okay, so what about AI then?
No, same thing. Well, AI is bigger than that. Okay, AI is bigger than that. Let's look right here in River City. Okay, you guys are about to release about a $500,000 award in national, in your NHS, to use AI and to digitally transform your health system, which needs some help. Now, we can use AI to aggregate the genome sequences and the health records of the population, say, of the UK into a unified federated image. And then we can use machine learning to predict, for example, who's going to be diagnosed with what disease in the next 5 years. Intervene clinically and avoid the diagnosis. Okay, this is a big deal. We can use AI.
Hang on, I think we've got a problem with your mic.
So I'll just talk about
okay.
it.
Can I react to something?
We can use AI for AI-assisted medicine. We can use AI for genome-specific medical protocols. And this is all goodness in light. We're delivering lower-cost health care to much broader populations, augmented by this guy, so we get to underserved populations. At the same time, these data will be used to ration health care. Hard stop. Who cares about, think about what's some of the dark side of this, okay? When we know that, one of us is going to be diagnosed with a terminal illness in the next 2 or 3 years, do you want to know that? I'm not sure I do. And the idea that whether we're dealing with a single care provider or the private sector, see Facebook for details, okay, the idea that all these organizations are going to act beneficially, I mean, you can get over that. And the decision will be made, okay, that you are too old, you have comorbidities or whatever, and we're not going to replace the kidney. Whereas in Switzerland, if you had $100,000, you go to Basel and you get your kidney replaced. So these are, this is an example of an enormously positive thing with very, very dark and deleterious consequences that we need to be careful of.
Frederike, were you wanting to jump in there?
Yeah, just reacting to what both of you said. I think what you're describing, Poppy, that's the ideal scenario. Ideally, we're adding AI to assist in decisions that are then carefully made by humans. What we're seeing, and again, I'm in the business of dystopia, so I am biased. I see the worst of the worst. What we're seeing is AI is used to reduce cost. One of my researchers is currently on their way to Jordan, where they're investigating an automated system that's been used to distribute COVID-related aid for the poorest of the poor. And we don't have the finding yet in writing, but what we're seeing is the sloppiest of the sloppiest potential application, where the questions are wrong. People can no longer access aid that they really desperately need to survive. So those are a lot of the scenarios that we see. And Thomas, that's what you mentioned as well. There's a real risk that we use AI to save costs, to provide healthcare cheaper. And as a result of this, and as an investor, that's something to really look out for. Not just does it work, but how is it maintained and regularly audited and used in practice? That's as important as the more fundamental question.
And in fairness, though, I mean, it's not all bad. I mean, we can make the, we can produce energy in a more environmentally friendly way. The grid can be safer. Okay, healthcare can be more affordable. People will be more healthy. There are positive results of these technologies, but there are deleterious consequences that we need to anticipate. And if we don't anticipate them and deal with them before they happen, we're going to have to live there, okay? And Orwell wrote a book about this called 1984, and we're not very far off in a lot of places. And so be afraid.
That's a positive outlook there. Frederike, why should it matter to an investor if a system is slightly biased, let's say, if customers are willing to pay for it?
Snake oil AI is primarily used in markets that are already quite broken, if I dare say so. Hiring, security, so it's used, snake oil is sold to solve problems that are objectively hard to solve. Who to hire, who's a security risk. So there will always be buyers, so that's not a good indicator. But the risk is, I think, two things. One is regulation is coming. We're seeing it in the EU. We're seeing the discussions globally. The second one is there's a real reputational risk, maybe not for investors, but for the company. I just was in Denmark, where apparently every single day there's now a news story about some government tech uses and scandals. So that's the second one. And then just finally, I just have to say that because I work for a human rights organization, also companies have human rights obligations that they need to meet and have a responsibility.
We've only got a few minutes left, so there's a question that's come in from a member of the audience, which is about the EU AI Act. Poppy, is that a sensible approach to preventing some of the most harmful uses of AI?
I think there needs to be more accountability, and regulation is a good way of making businesses and people and societies accountable to the way that they use technology. And I will just point out that AI itself isn't bad or biased or malicious. It's just a system that is learning from you and the data that we all consume. And if you give it biased data, you're going to get bias pop out the other end. So you do have to be thoughtful in how you're training these systems and how you're applying sort of ethical considerations. My nervousness about regulation is that this is an industry that is changing incredibly fast. Like the amount of innovation, the amount of capabilities that is coming out is changing month to month. And regulation doesn't happen at that same space. So you're only ever going to be regulating for the world that's already refined to yesterday's world. So I think the market needs to be a little bit more developed before that regulation can have a more powerful impact.
Does anyone else want to weigh in on regulation?
Well, this bias issue, bias only relates when you get to people. Okay, so when you're dealing, most of what we're applying to AI is to machines. So we're dealing with torque, temperature, rotational velocity, and you were optimizing, production processes and operational processes of aircraft or production lines. There are no bias there. These are just hard physical data. Bias is when we get into sociological data. For example, we're dealing with the criminal justice system. We're going to, there is enormous social bias in those data. And when we apply AI to that, we will simply perpetuate that cultural bias. So that is, it's very legit. But bias only relates to where we have the interaction of AI and humans. And honestly, that's about 20% of the application of AI in the world.
Right, we've got very little time left, so I've got one last question. And I want you to all answer with just a couple of words. And you're not allowed to include your own companies as an answer. Name one AI company you'd invest in and one you'd run away from. Tom.
I don't know how anybody could ethically be a Facebook shareholder, okay, and look themselves in the mirror in the morning. Okay. I don't know candidly how anybody could work there and look themselves in the mirror without slitting their throat, okay?
Oh, okay. So that's when you...
Give me a minute, I'll tell you what I really think. With these people, the damage they're doing to teenage girls, the market they're creating for slavery in the Middle East and Africa, this is the primary means for, facilitating the slave trade, the Middle East and Africa. How bad can this get?
Okay.
And so
you won't invest in Facebook. What about a company you would invest in? Just the company. Let's.
In AI, I honestly don't know. I don't know.
I've got a recommendation.
You can recommend each other's companies.
Frederike, how about you? What do you?
I would not invest in computer vision companies that add sort of identity prediction. There are these companies that have patents on identifying Uyghurs in a crowd in China. The entire computer vision industry, there are some real issues. What I would invest in, I'm not an investor, there are some really fascinating uses of AI in the human rights space, for example, to train AI to detect weapons, and that's really useful, for example, for our work in Ukraine to detect whether cluster munitions have been used.
Okay, and Poppy?
I struggle to talk out particular names. I think AI's got some really interesting use cases in healthcare and being able to sort of pull that bioinformatics information together, and I think that's sort of really good. But fundamentally, I don't think people should be investing in businesses because they use AI. They should be investing businesses because they solve problems. And as long as those problems are being solved, that's good.
So you're not going to name any company you'd invest in?
No, I'm not.
Or that you would run away from?
Correct.
Okay, on that note, we've run out of time. I'm sorry we didn't get to all the questions, but thank you very much to my brilliant panel.
Please welcome to the stage José Neves, founder, chairman and CEO of Farfetch, and Bloomberg Television's Tom McKenzie.
All right. José Neves, CEO of Farfetch, thank you very much. Indeed. There is so much to touch on with you and with your business and with the biography of you as an entrepreneur. But I want to start back in 2007 when you founded the business, and then you had to navigate through the financial crisis. You had to navigate through the Eurozone crisis, and then potentially, possibly, arguably, this unique moment that we're facing right now. Inflation, geopolitical risks, cost of living crisis. Talk to us about, as you look back, the meshing between technology and retail, and particularly the luxury space, and how that's evolved over that time, how you've managed to navigate all of those different challenges by bringing those together.
Look, it's a very passionate topic for me because I started as a coder, actually, as a computer programmer, and I'm from the north of Portugal. There's lots of fashion companies there, factories, studios, more industrial companies. So those were my clients. I started developing software for the fashion industry when I was 19 with our CTO. So we date back 30 years or something like that. And then I came to London to be a shoe designer when I was 22. So go figure. And I fell in love with the fashion industry. It's about it's part of culture. It's about creativity, craftsmanship. And quality, and it deals with emotions, deals with individuality, expression of one's individuality. So it's absolutely fascinating, and it always, for me, the most fascinating thing was how are these two worlds going to come together, and how can technology foster this part of culture that is fashion, and vice versa. And how can we bridge those two worlds? And that's Farfetch. That's the core of the mission of Farfetch, is to bridge these two worlds of the creators and the curators of fashion and lovers of fashion all around the world. And yes, we've been through major crises since, we launched October 2008, and 2 weeks later, Lehman Brothers went bankrupt, and everyone thought the world was going to end. No one would buy anything, and that was the year 2009. It was the only one of 2 years where the global luxury industry dipped, and the other one was 2020 with COVID. So for 25 years, this industry has been incredibly resilient, actually, and obviously we've seen the digitization of the industry take place. It was an industry that was always very resistant to technology, very fearful of technology, because, in a way, it's human versus machine, and we were watching the previous panel and very powerful conversation around that. But the machine can help the human, right? And but that debate, that tension, you feel it in the fashion industry, and our journey has been really to try to bridge those two worlds.
What are the next barriers, do you think, that will crumble in the face of this tech evolution? We've seen, of course, the acceleration during the pandemic. Acceleration as a catalyst, that event. What are the next barriers that are going to fall as tech continues to evolve?
I think there's so much to do. If you look at the penetration of online in the luxury industry, it's only 22%. Pre-COVID was 13%. So it actually doubled to 26% during COVID because the stores were closed. They normalized to 2022, but 80% of fashion, of high-end fashion, is still bought in physical stores. So for me, the ultimate frontier is how do you dissolve the barriers between physical and digital? How do you make the physical star, how do you bring the human interaction that is unique to a physical star and elevate it through technology? Because if you go to a star today, it's the same as experience as in the 90s. You just have a contactless maybe payment, but you still, the salesperson still disappears to try to find your size and comes back, sorry sir, don't have it, let me call another star, etc. So there's even basic things like that. Payments, you still queue up to make your payments, or maybe they bring, if it's a more elevated star, they will bring the machine to you, but it wasn't touched. It's one of those areas in our lives that wasn't touched by technology. Everything else, even Starbucks, you can order on an app, right, and just show up and pick it up. And luxury really hasn't fully embraced this digitization, and for a good reason, because it can sometimes kill the customer experience, and they don't want that. But how can we apply technology to elevate the human experience in store? And that's what we've done with Browns here in London, in Brook Street, with a company we acquired 5 years ago, very iconic 50-year-old retailer, and we invested in technology to make it the shopping experience of the future, with Chanel in France, and now with Richemont, the plan is to bring this, what we call luxury new retail vision. So for me, actually, it's quite simple. The next big frontier is how do we digitize not just pockets of the industry, but how do we unify the entire experience, both online and offline, and bring that together. And that's where the biggest opportunity is.
Without losing that kind of exclusive cachet that goes with luxury. And what role would AI play in that?
I think it plays a really important role, but always in terms of assisting the human. It's actually one of the most complex problems in AI is fashion, because it changes all the time. It's driven by creativity, which is something that machines don't deal very well with, and it deals with cultural trends, with the zeitgeist, and just because everyone is using polka dots doesn't mean that you should continue producing and designing polka dots. Probably the other way around, right? And it can change from one season to another, or from one week to another. And this is extremely difficult for computers to predict. So it's really, if you speak to the real experts, AI people that have focused on solving the fashion problem through AI, they'll tell you that this is really about assisting the human, but the role of curation and the role of creativity will be human-led, I hope forever, but at least for many, many years to come.
How are you thinking? I should at this point, by the way, say that please do send in your questions as well to José. They'll come up on the screen. We'll put them to José throughout this conversation. How are you thinking about the metaverse? And I don't want this to be a platform for Facebook bashing, but when I think of the metaverse, you do have obviously, you're drawn to that image of Zuckerberg's legless avatar. Are you confident this is more than a pie in the sky kind of aspiration? How important do you think the metaverse will be for that kind of goal of yours, which is the greater digitization, particularly that consumer and customer experience?
I prefer to talk about Web3 as opposed to metaverse, because the metaverse for me is a sub-component, is one of the ideas around this revolution that is Web3, right? And for me, the best definition is Web 1, and as a computer programmer, I was Web 0, like no web in the 90s, right, in the early 90s and 80s. So then I saw Web 1, and Web 1, you can think of it as read, as an internet where you can read stuff. And that's Yahoo as a portal, and where you would find the links or other places, or Netscape. Those are very early, non-interactive, one-direction portals. So that was Web 1. And then Web 2 was about user-generated content. And companies like Farfetch, Airbnb, Uber, like two-side marketplaces. And obviously social media, etc. So that it's, and you can define it by read-write. So you read and you write, and the system interacts, and out of that interaction, the experience becomes much richer, much more powerful. And Web3 is about read, write, own. So it's when you're actually owning the assets. Your data, you can own your data, you can be rewarded financially for interacting with the systems, and in a decentralized way. And that is very, very powerful. So I truly believe that Web3 lives up to its name, and it will be the next step and stage and revolution.
So how do you position for that? Are you investing in areas? Are you doing R&D in this space?
Oh, yeah. I think now, the metaverse is one of the ideas. You can mention crypto, DeFi, NFTs, et cetera, and then you have the metaverse, and metaverse is one of the ideas. And quite frankly, my personal opinion is I certainly don't think it's going to be owned by a corporation and a company. And I think that a totally virtual world and experience is ultimately inherently unsatisfactory, because we're three-dimensional beings. You know, like we were talking about the difference between being here and being on Zoom calls for a couple of years, right? It's very different. Even for the audience that is watching us, the fact that we are in the same space grabs their attention much more than if we were both on Zoom, right? We were just talking about this. And because we're three-dimensional beings driven by feeling and emotion, that translation in a virtual world is very poor indeed, and I think it will always be. But it has its applications in gaming, for example. But gaming is already huge, right? So I think actually you will see gaming, in my view, games becoming metaverses, as opposed to the other way around, because it's much easier. If you have a huge install base already, it's much easier to decentralize, and there are economic forces at stake there. But in a way, it has to be gamified. The idea that I just go because it's a more satisfactory experience than in the real world, I think is absurd. And therefore, I think it's going to take much, much longer than what some people are predicting. And definitely being owned by a company is contradictory to the whole philosophy of Web3, which is decentralization. So it will, if it happens, it will take time. I think it will be gamified, and it will be decentralized. It will be a protocol, ideally, right? And that's the way the metaverse is going, I think.
Really, really interesting. I'm just going to loop back to the AI question, because we've had a question come in from the audience. How can you use AI to make the fashion industry more sustainable?
That's an excellent question. I think, first of all, the fashion industry has huge sustainability issues. It's very polluting. There's a lot of overproduction. I think actually overproduction is the lowest hanging fruit and the biggest impact that we can have. If we can just predict better what people are going to buy, produce less, ideally even produce on demand. I'm an investor of a company, and I'm on the board of a company called Platform.me, pardon the publicity, that works on demand luxury, and working with companies like Hermes, companies like Dior, where the items are not actually produced until you buy them. So you have zero overproduction, and that's very powerful. The other thing is companies like Vestiaire Collective, Real, et cetera, that are in the circular economy, right? So if you can buy something that was pre-owned, that certainly extends the life of the product. In terms of AI in particular, predicting the trends. Can hear myself. Okay,
there we go.
Okay, it's working now. I think that's one concrete area, but there are many other applications. I think sustainability is a vast topic, and we're very active with clear sustainability goals at Farfetch for 2030. One of them is to be more circular than linear, and we've invested in pre-owned.
What about creativity? Another question's come in on the question of creativity and AI, whether AI enables creativity within luxury space, or in fact degrades that, and there's a risk to creativity if you start to pull in AI.
I think it enables creativity, and if a company wants to replace creativity by AI, they will fail very, very fast. AI is really certainly not in fashion. I don't know in other areas, but it's certainly decades away. If you're an optimist, if you're an AI maximalist that believes that computers will do everything better than humans, I fundamentally disagree with that, but what do I know? I'm not an AI expert. But even the experts that are AI maximalists, they'll tell you we're 20 years from removing the creative function and job of humans in an industry like fashion. So it's always, so if a company attempts to do that, they will fail very fast. However, let's not dismiss it, because I mean, the amount of stuff that gets produced, industrialized, and ends up in the landfill, just because people are not using data at all and not using AI at all, to your point around sustainability, it's a huge missed opportunity. We shouldn't do that. We shouldn't dismiss AI. Let's use AI so that we can predict trends and have a more sustainable industry.
Okay. I want to talk about deal making. We've got a chart I think we can throw up that shows how active you've been in terms of partnerships, deal making, investments, the likes of Alibaba, JD, Reebok, of course, and most recently, arguably your most significant, which is the 47.5% stake in YNAB, Yoox Net-a-Porter. Talk to us about the rationale behind that deal, where it positions you, how it positions the company, and whether you're going to be taking over all of those shares ultimately.
So the rationale is really about our vision for the future of luxury. As we call it luxury new retail. For us, it's the convergence of physical and digital. And that captured the attention of the luxury industry. A few years ago, we had a conference in 2016 where we laid out this vision. And we've developed technology that really brings those two worlds together. Cartier, maybe the most important maison in the Richemont group, really loved everything we were doing with other, not in hard luxury, but in fashion. And we worked very closely with the Cartier management team to see how this could be applied to hard luxury. And they came to the conclusion that to the next step in the digital strategy and advancement for Cartier, and then socializing it with the other maisons for the Richemont group, was the Farfetch vision and the Farfetch technology. So it actually came from the technology side. And at the point we said, well, if we're going to do something really big and strategic with all the maisons, we should also re-platform YNAB. But of course, if we do that, then how do we align interests between the two companies? And that naturally evolved to the deal we have today.
Do you take full control at some point?
So right now, there's regulatory approval to go through. We will, after a successful regulatory approval and completion of the deal, we will own 47.5%. So no one will have a controlling stake in that company, so it will be joint control. We're very excited to work with Richemont Group in the transformation of YNAB from a retailer, a luxury retailer, a very prestigious luxury retailer, but a retailer still, into a platform, a true platform where brands can sell directly. And this is transformational for the industry because there are more than 1,500 brands and designers, some of them small emerging designers, that use those platforms and that sell on those platforms, a very important part of their business, and we can enable them to go direct to consumer through those platforms.
Okay, we're running very short of time, and in fact, we've run out. But one last question I have to ask you. The dollar at record highs, the euro at 20-year lows, the pound, of course, front pages, levels we haven't seen since the 1970s. Good or bad for a company like yours, listed in New York, dealing with European luxury?
From an accounting and reporting perspective, bad, because we report in dollars. So even though we're growing in euros, and in certain areas of the business growing very fast in euros, you then translate it to dollars, and it's much lower growth, or even dips into negative growth. So we reported negative growth, small negative growth, but it was actually positive growth in constant currency. So that's just the translation. It doesn't. And the sophisticated investor reads through that and understands that the underlying business is incredibly strong. Of course, we had the war in Ukraine, the COVID-19 situation in China, which have materially impacted our growth this year. But the rest of the world, the underlying business, is extremely strong.
Okay, José Neves, CEO of Farfetch, thank you very much indeed. That is the time. So we've got loads more fantastic conversations coming up, including on crypto, the metaverse, and a conversation with the CEO of Zoox as well. There's a break now. I've been told you need to be back in your seats by 10:55 sharp. So thank you all very much.
Thank you, Tom.
Blinded by the lights, we came to shine here. Watch it look daytime in the night. We bring the vibes here. We full of life, you keep the change, keep the change. They hate and say we went and changed. I stay the same. You must be blinded by the lights. You must be blinded by the lights, lights. Yeah, 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 yeah. Some faith, then who gon' hurt this? I naughty night, you lullaby. I'm doing me, it's do or die. You must be blinded by the lights. We came to shine here. Watch it look daytime in the night. We bring the vibes here. We full of life, you keep the change, keep the change. They hate and say we went and changed. I stay the same. You must be blinded by the lights. You must be blinded by the lights, lights.
Ashamed, think something new under the sun. You can't take back them things you already done. No. You blame things that you do on somebody else. No. But they all see is you need help. But still you try so hard to cover up your games. You try so hard, hoping that one day something gon' change. You waste all of your time covering up your tracks. Spend all your days running away. Now you gotta watch your back, and that's the facts. You spend so much of your life scheming and trying to get over. Got you wondering why you come around. All you get is cold shoulder. Yeah, you try so hard to cover up your games. You try so hard, hoping that one day something
Please welcome back to the stage Brad Stone, author and senior executive editor for technology at Bloomberg.
Welcome back, everybody. What a fantastic morning so far. Hope you all had a chance to get some refreshments. Let's continue with our program. Recently, Bloomberg Media's Nicola Porter caught up with Joseph Bradley, the CEO of Autonomous, one of the sponsors of our event. You may know Autonomous by a different name. Joseph started the conversation with a business update. Listen in.
Before we dive in, I'm excited that you have got an important update to share with us.
First, it's great to be here. Super excited. We just recently announced a name change, and that from Tech and Digital to Autonomous. And we're so excited to really show the world what does it really mean to transition from smart to cognitive.
So let's jump into that question. That's the first thing that I was going to ask you, is what makes the difference between a cognitive city and today's smart cities?
Yeah, when you think of smart cities today, Internet of Things, IoT comes up, and that's exactly what a smart city fundamentally centers around. It centers around machines. But when you think about the flow of life, it's around humans, not machines. Cognitive focuses on people and human centricity. Oftentimes in a smart city, they sacrifice human centricity for efficiency. In the cognitive city, it's all about that human experience. Secondly, when you think about a city built around machines, it's oftentimes about one-time transactions. In a cognitive city, it's about establishing relationships. It's about creating a 360-degree learning loop with how you interact with that city and learn from it, and the city learns from you. And finally, when you take those two together, ultimately it boils down to a smart city is very, very reactive. The damage is done, now what do I do? Well, cognitive city is proactive and predictive.
What technologies that underpin a cognitive city will transform the lives for the better for the residents that live there?
Yeah, when you think about transforming, people's lives, the technologies fundamentally underpin that are AI, robotics, and trust technologies. They really change your experience, and they do that in three ways. So the first, you can think about friction. How hard is it to do things? Man, going to the airport now with COVID, all this friction. Well, imagine a world in which you see your luggage when you pack it, and the next time you see it is when you walk into that hotel and it's there. So eliminating that kind of friction. Secondly, it's all about giving you time back in your life. Man, time is so precious these days. The ability for when you're waiting at an airport, you got an hour and a half. You know what? It'll tell you exactly what places you can go to and where you can shop within that time frame. Or most importantly, giving you back what I like to call moments of truth. In other words, if you get home 30 minutes early, you get an opportunity to share a story with your son or your daughter, or spend time with the quality of a loved one. Those moments of truth are what make us more human, and that's really ultimately what cognition is all about.
What role will data play in the cognitive ecosystem?
Yeah, really, really important question. When you think about data, it starts all with the word trust. If we don't get your trust, we don't get your data, we can't create any value. So when you come to Neom, it is your choice. You are in full control of what happens and who uses and who sees your data. We understand that could be a daunting thing for many people. I mean, if you go to today's world, you go to a website, it's 500 pages, you just click and say accept and hope and pray that it's going to be okay. What we have done is create a consent management platform that provides you with a common architecture, an easy way for you to put all your preferences in. And maybe you're not an expert in medical, so you might say, hey, guess what? I want to allow my doctor to set my preferences because I trust them. So you can not only do it yourself, or you can assign proxies. But the point is, you are in control. Now, when you come to Neom, we want you to experience all the great predictability. We want you to enjoy yourself. We want to save you time, make things easier for you, allow you to spend more time with who you want to and what you really want to do. But in order to do that, we have to have your information. And so if you allow us to, you will experience something that you've never experienced before. You will experience what it truly means to be free, what it truly means to maximize your time and enjoy your loved ones and enjoy nature. But if you decide not to, then quite frankly, maybe you're not ready for Neom. Because if we don't have your information, we can't deliver that experience. But we understand that you are in control, you're at the center of it. But man, if you take that first step, you'll never forget it.
How is your team and yourself transforming this elaborate vision into actual reality?
Yeah, it's a great, great question. Everyone on the team is so excited, been working so hard for the last 24 months, whether it's $1 billion we put into core technology. We're talking about AI, robotics, blockchain, whether it's the investment in compute capacity with our hyperscale data centers, our core networks, fiber, 5G that we've installed in the environment, or we go back to human centricity. We invested over $500 million in how do you foster ideas, how do you gain entrepreneurship at its core so that we can solve problems that we quite frankly don't even know will exist when this project is completed. So it's all around both on the infrastructure side, it's on the application side, and more importantly, it's really investing in people, entrepreneurship.
And this is the first time in history that a digital twin city is going to be built at the same time that the real physical city is being built, is that right?
Yes, it is. We're super excited about that. If you think about a digital twin, what does that mean? It basically means that you have a digital representation of the physical world, but here gets where it really gets cool. They also intersect one another. So I could be in a digital world in trying to experience Neom on my computer or PC, but I actually show up physically in Neom as a hologram, where I can interact with someone, or we can share a story, or we can share an experience. So it's the melding of these two together that's incredible, and the experiences are just amazing. So we're super excited about that. It's in everything we do. Also, when you think about digital and being able to create a digital twin, in the real world, there's only one of you. Well, when we go to digital world, you could have multiple of your personas interacting at the same time with a variety of group of different people. So you might have one persona interacting and teaching kids around your favorite topic or subject. You might have another persona where you're giving a lecture, or you're enjoying friend time, or you're watching sports. So it really, at the end of the day, it makes you more of you. It's all about how do we bring humanity into a city and really put humans at the center of the conversation.
Thank you, Joseph Bradley, for joining me today on the sponsor spotlight of Lifting the Lid on Cognitive Cities.
Autonomous. The very name implies what we're about. Technology. Autonomous. It's about fundamentally giving the world an opportunity to reboot by deploying real, innovative, cognitive solutions.
It's a journey that's best taken with others. Together, we are realizing our digital empowerment, a people-centric future.
We want to make an impact in the way we work, live, and play.
Please welcome to the stage Dr. Giovanna Graciosi Casimiro, XR and Senior Metaverse Producer at Decentraland Foundation, Adriana Hoppenbrauer Pereira, co-founder of The Fabricant, and Jeffrey Perez, Head of Luxury at Snap, with Bloomberg's Gillian Deutsch.
Hello, everyone. My name is Gillian Deutsch, and I am Bloomberg's tech correspondent in Brussels. So usually I'm covering the world of tech regulation out of Brussels, but today I'm very excited to be hosting this conversation about the future of the internet with one of our favorite buzzwords in the tech universe, the metaverse. Specifically, we'll be talking about the potential for the fashion industry in the metaverse. I hear so much hype about what the metaverse could bring for brands, for fashion houses. It could be a new mechanism for advertising, finding new audiences. We also could see a whole new way of trying on clothing. We also might all have digital closets when we open up our laptops in the future. But where there's lots of hope, there's also lots of hype and lots of skepticism of what this world will actually look like. I'm sure many of you have seen the videos and photos of Mark Zuckerberg's vision of the metaverse. And there, Mark doesn't even have legs, let alone trousers, to purchase and wear. So I want to have this conversation about what the metaverse is actually going to look like. And with that, we have some really great panelists here. I want to kind of start off, though, with a bit of a show and tell, because you can't talk fashion without showing a bit. So I want each of our panelists to kind of explain what their companies are doing in the metaverse, what their vision of the metaverse is, and we have a little clip from each of them to kind of give you guys a good image of what that would look like. Dr. Gigi, you want to start?
Of course. Hello, everyone. Can you hear me? It's a pleasure to be here. So I work with Samsung.
horizontal, the vision of the metaverse. And I think that's how the future stands for. It's about community, it's about an opportunity to make an internet from people to people, above the tool, people.
Thank you so much. Adriana, do you want to talk about the Fabricant?
Yeah, good morning. I'm a co-founder of The Fabricant. The Fabricant is the first digital-only fashion house, launched in 2018 in Amsterdam. And we built, besides our own collections, a platform that allows anybody, a fashion brand, or an influencer, or a designer, to actually launch their own collections for the Metaverse direct to avatar.
Thank you so much. And Geoffrey, I think you even have specs with you, am I correct?
I do, yeah.
Excellent. When we have a video, can you explain what Snap's vision of the Metaverse is?
Yeah, of course. So Snap is a messaging app, as you probably know, but a messaging
embracing
app that
people of all races, all sizes, all age, all socioeconomic background. But when you have your phone and you can direct it to an outfit and see yourself reflected in that and be able to be whoever I want to be, and you can see yourself.
Within the camera, we also have 3D filters. You know, every day we have 250 million people engaging with augmented reality on Snapchat. So this is where we play with fashion brands and we engage with them so that people can not only try beauty makeup on, but they can also try watches, sneakers, jewelry on, thanks to augmented reality filters that live in the camera.
Thank you. I am glad you guys all got some visuals. I want to start off with you, Adriana, because I know for many of us, our first introduction to the Metaverse was Mark Zuckerberg rebranding Facebook to the Metaverse. You've been in this world for much longer, though. Can you walk us through where was this industry in 2019 when you first began, and where are we at now?
Yeah, when we first began, nobody really understood it. So we would be in conference like this, and minimum people would think like, yeah, right. Sci-fi story, really interesting, but this is never going to happen. And I think COVID really accelerated the understanding of this meta reality, which is the reality that we all live in already digitally, and how having our digital personas became super important because we're only interacting mostly digitally with each other, right? So we saw an enormous acceleration of not only the understanding of it, but also the entertainment industry, the gaming industry taking a lot of space during the COVID times where, again, we were meeting and entertaining ourselves primarily digitally. And that is when fashion brands actually woke up to this opportunity together with I would say also the more democratization, what we call NFTs, which are digital files that have ownership in blockchain. So when we talk metaverse, I always say metaverse is two sides for me. One is immersive experiences. It's 3D experiences, augmented reality experiences. It's a new media type. It doesn't replace photography, doesn't replace videography, doesn't replace text, but is another way that we will be able to express ourselves. And the other side of metaverse is the blockchain, which then allows us to own virtual objects and transact those virtual objects among ourselves. And the combination of these two elements together are now what I would say very well understood in the fashion industry. There has been a huge boom in the last year of fashion brands dipping their toes into the space, creating collections, doing metaverse fashion shows. And we have been in a very good position to help and facilitate that conversation and that introduction of the traditional world into the digital world. And ultimately, what we always say is, if you are in the fashion business, you know what it takes in terms of capital, supply chain, stock management. None of that happens in the digital world. So that is like the nice sound of, oh, there is money to be made, there is a business to be made, and it's highly profitable, great. The other side is that we are going digital. We are all establishing our digital presence, whether it's through AR filters like Snap, whether it's through Decentraland events. It is happening. So it's a new business model that certainly is extremely interesting for the fashion industry where it is. It is more sustainable, it is more democratic, it's more creative, and it's more profitable.
Jivan, I want to talk to you because you have obviously worked with many big fashion houses. What are our brands' perspectives right now? They're kind of dipping their toes into this, but they're still a bit wary. Can you explain where brands are actually at with engaging in the metaverse? What are the mistakes that you see as well?
Right. I think based on our experience in Decentraland and in the Metaverse Fashion Week, I think right now is a great moment for experimentation. I think brands can really try to expand their storytelling. I always like to say that the metaverse is not a new thing. It's something we have been building. Look at Georges Méliès, what he used to do with the beginning of the cinema. So we're just trying to unlock creativity in many ways. And the metaverse is the next generation of that. So brands, I think, are coming with very open mind, trying to figure out how they can bring their identity. And then I think when they talk to strategists and consultants, I think it's great that they try to find their path and not always follow a standard behavior. They not always have to do an NFT drop or be a DAO. I think brands are trying to comprehend. And also, I think they're giving themselves an opportunity to co-create. And I think that it's, for example, the Fabricant, but also so many creators in the Decentraland community, how a big brand in the fashion industry can create a collection with the new generation of creators in the digital realm.
I also want to bring this to Snap, because Snap has quite an interesting perspective on engaging in the metaverse. I mean, obviously, many people here probably used Snapchat, or maybe your kids have used Snapchat, you use Bitmojis, right? I find it quite interesting you guys are not trying to sell like Levi's digital-only clothing for your Bitmoji. What is Snap's involvement in the metaverse, and why are you not doing that?
Well, if we start first with the biggest portion, which is augmented reality, we truly believe that the next computing platform, and we've heard José Neves talking about Web 0 when he started computing, Web 1, Web 2, Web 3, that version is going to be about experiences. And we strongly believe that human needs to be at the center of these, and that's why we are so engaged into augmented reality, which is a digital layer on top of the world that's existing around you. We want to add that layer for people to feel it and to see it. Today, you do it with Snapchat, and you open up the application and you add a filter onto your feet, onto your hand, or whatever. But tomorrow, the way we see it progressing is that connected devices are going to be everywhere, and digital is going to be so fast with the 5G coming up, etc., that we will be able to fuel these connected devices. And you talked about the specs, which are
Should show them off, yeah.
Should I? So these are the Snapchat sunglasses, like glasses, I would say, that have computing overlaid on top of the world around you. This is how we see engaging with the real world around us with that digital layer that I was mentioning.
It's quite a fashion statement wearing those around.
It does. So that's what we're doing with augmented reality and with fashion brands, trying to create together for the human. The human word has been named a couple of times also today, and that's what we center around, the reality of humans, adding that layer of computing. So to answer on Bitmoji, because that was also one of the questions, it's clearly one of the biggest avatar in the world, and we're very cautious into the way we market it. So that's why we're doing a few collaborations with brands, but we're not selling outfits there. Not yet. I'm not saying never, but
never. But do you think that this push for digital-only clothing is overhyped? Is that why you're so cautious about pushing that kind of thing?
Not saying it's overhyped, but we are really engaged with the real world. So there's definitely a digital world. Our lives are becoming much more digital in a sense, and we've been working a lot with the Fabricant and experiencing with Dr. Gigi. And so there's definitely not just a trend and not just a hype. That's a subject. But we're engaging with augmented reality right now.
Now, I do want to ask for all you two who participate right now, I have a very unscientific poll that I want to gauge with the audience. Raise your hand if you've purchased an item of clothing on the internet. I think most of us probably have. Okay, now keep your hand raised if you have got some hands. Okay, good, good. I'm curious though, so I don't know, Adriana and Dr. Gigi, which one of you wants to be in the hot seat, but you've got quite an audience of untapped audience of people who could buy these digital-only clothing. Why should they go and buy some skins and buy some of the clothes that we saw?
First, I think because we are changing culture, right? So I think we are dealing with a cultural transformation. We're not just here from the business point of view. That is, of course, a big part of it, but we're changing the way we see ourselves. So first of all, if you want to build a different identity, complete your identity in a different way, expand your body existence. And because I do feel that in the future, our physical clothes will be triggered and expanded by animated elements and another layer. That will be just a normal thing 10 years from now. We already saw the product that is going to trigger that.
I can have a go. So if today you go and buy a bag of $400 of a brand, so let's say Gucci, a brand that I like, you got an identity you associate to that brand, and you got a bag. That's all you got. If you try to trade this bag, you're probably going to have $200 because it's secondhand. It's a pain. If you ever try to sell secondhand clothes, it's not that easy. And that is it. So your relationship with the brand is very transactional. Once that brand is digital, it can augment your identity digitally because you are a digital avatar and you're living a digital life. You paid $400. It is a limited edition, and you're probably going to sell it for $4,000. Besides that, having the ownership of that bag means that you're part of a club of Gucci. You're going to have access to things that other people don't have. Because this bag is also your kind of VIP connection with Gucci in the virtual world. Everything that I said right now is already happening. The only thing that is not happening is that the 3D environments that exist, like the Decentraland, are not yet at full scale that we all feeling confident and comfortable to go there and play around, right? It's one of those things in 1 year from now, it's going to be gone. It's the pains of early technology. We're not using them to its full potential quite yet. But it's a very short period of time before it takes off. The other one that I think is close to everybody's heart, and certainly for everyday use, who is in daily video calls? Some people are in RAO, that's great. I'm every day in video calls. Now in video calls, I'm every day, I'm wearing my pajama pants and maybe a nice top. I don't need to put my makeup on because Snap Filter has a makeup filter that I can put on. And actually, I can put my jewelry from the fabricant on the calls as well and make quite a statement. I can change it for every call without leaving my chair, right? I can actually change my identity without leaving my chair, and depending on the call, I might do a different accessory, a different makeup, or a different top. That's already happening. So the Snap functionality that we use, you actually can have the fabricant accessories to wear on your calls, which is a world that we're all living already. So I think that is why digital fashion is more interesting than physical one.
That's very interesting. Of course, we want to talk about the economy. It would not be a Bloomberg Summit if we don't talk about the economy. We've seen headlines about Nike selling an NFT for over $100,000. This is obviously very intriguing for brands. But in our daily lives, the question on all of our minds is, are we heading for a recession? We already heard it, we're already in a recession, right? People have to obviously buy physical clothing. We obviously all need to get dressed to come here. Why should people spend $400 also on virtual clothing? Do you think they really will, especially as everyone's looking at their budgets and saying, okay, I need to cut something. Is this really necessary? You're nodding your head, Adriana, if you want to say that.
No, that's good. Because I'm a bit controversial when it comes to NFTs because I think we have lived the normal excitement of new technology bubble. And if anything, I think the times that are now are normalizing times, and I really welcome that because it means that now we start building products that really have validity. And we get out of this kind of initial excitement, right? So I do believe that the price that we have seen in 2020, 2021, 2019, I hope, and I do also believe are not going to be reached that easily anymore. That you need to be giving a lot of value to justify the $100,000 for an NFT for a picture. It's normalizing times, and it's great, which means that people that build and are building products and are building solutions are the ones that are going to stay and going to win.
Siobhan, I want to ask you, though, I mean, given the current economic situation, how has that affected Decentraland?
Oh, I think that the central land actually is composed by so many users and creators. So, of course, that if there is a recession, the studios that work with brands, they may feel it. But right now, I think majority of the studios are really working in full steam. We have many events in the virtual world. And I think it's interesting for us to analyze that sometimes during recession, you try to find other ways to gather people. And virtually, a lot of costs are lower, right? So sometimes, rather than you doing an on-site event, you would do a virtual event. And so that economy particularly get benefited. So I think for us, of course, the hype of Metaverse that happened in February, now also the NFT crash, I think it brings a little bit down to the place where whoever is in those Metaverses is a real consumer that believe on that idea and people that really want to build that together. So we are seeing that fluctuation and understanding who is going to really stay to build something powerful.
Jeffrey, I want to ask you about the reality of using augmented reality to try clothes on. I mean, I remember growing up, going to the mall, try on shoes, my mom making me walk around the mall multiple times to make sure the shoes actually fit, checking to see if there's room in the back of the heel, right? So, I mean, you can try stuff on virtually, but obviously the feel, the fit, you can't see that, right? You need to actually try that on. So are there too many limitations to using augmented reality for the metaverse, or how will it actually be useful to people?
Well, actually, there are, of course. If you look at different fabrics, they don't move the same way, they don't weigh the same weight, they don't look the same with the lights, etc. So there are definitely limitations, but we have been improving so much in the past, let's say, 2 to 3 years. We have new technologies such as the ray tracing technology that's often used in gaming and virtual spaces to show the lights and the reflections. And if you look at what we've released, I don't know if that was on the screen, but we've released that Tiffany bird on a rock with before and after we use that ray tracing technology. And the one using the ray tracing technology is just duplicating the exact product that you have in real life. And if Tiffany's has said yes for Snap to work on that iconic piece, I think it's at some point it is really a statement saying, okay, the technology is here for diamonds. It's not there, let's say, for apparel. Apparel is very tricky because if you want to wear something on, you're not the same size, you're not the same weight, so apparel can get very tricky, and the fabric and the movement, etc. But we have acquired a few companies that are helping us solve that and increase accuracy within the fitting and the sizing of things. You probably have heard of them. It's Fit Analytics, which is a sizing tool that lots of retailer websites use. You want to go there and you don't know what size you are, and so you're going to pick your weight, your height, etc., and then they're going to tell you you're small in that specific product. So we're trying to bridge the gap between these frictions that you might find online and bring these new technologies onto our service to increase accuracy. So fitting, sizing, rendering sometimes is a challenge, but if you look at what we've accomplished in the past 2 to 3 years, I think it's pretty impressive. And we've been working with all of these luxury brands, Dior, someone was mentioning Cartier earlier, Prada, Louis Vuitton. They are at the zeitgeist. They have the exquisite sense of craft, and that's what we're trying to replicate on the platform. So, yeah.
Absolutely. I mean, I also am coming from the Brussels regulatory world, where often people talk about the negative implications of social media. So I obviously am looking at the metaverse, and I've reported previously on possible harms in the metaverse, of course. And one of the things that when we're looking at fashion, I know, Giovanna, we've talked in the past about, one of the looks for people in the metaverse is it's quite crazy neon colors, but also you see, lip fillers, cheek fillers, trying to make their avatars look almost like brat dolls. And I remember growing up, and brat dolls were criticized, right, for promoting negative body images for young girls. Where do you see your products fitting into the metaverse, making sure they don't harm, especially young girls?
Yeah, I do feel that that's why it's so important that we set up the Web3 based on communities, because I think the communities, they're people, we are all part of that. And the example we have in the Decentraland, yes, we do have some Bratz doll faces, but we also have completely non-human characters. You can actually create your identity without any specific beauty standards. There is no beauty standard in the metaverse that you say, oh, this is the way you should look like. So we have this image from Dolce & Gabbana catwalk in which the models were cats. And I think this is an interesting statement, but you also can see that coming from the individuals, which are regular people creating in our community, that you can be whatever you want to be, and it can be a different you, or it could be you as you are in the physical world, but with additional features. So I think it's really a space for freedom of expression. But we have to be together and stay together in understanding how we don't harm the new generations. And I think people are very aware of that. That debate is very important in this space.
I want to bring it, we have a couple of Q&A questions from the audience. One is from Karen K. How will you make the metaverse and the fashion inclusive to working and lower class individuals who don't necessarily have the hundreds of pounds to spend in a digital world? Adriana, do you want to kick us off with that?
I love this question because it's actually one of the reasons I'm in this space. Is when we're creating this Web3, it means that, again, ownership means true ownership, and we have the opportunity to actually leapfrog the economical system that exists right now, whereby anybody, anywhere in the world can become a fashion creator, sell their collections, make profit out of it, buy new collections, resell it, right? So the fluidity and the liquidity of the trade is going to be much bigger than what we have right now. And truly, the only thing you need to launch your label in the metaverse is a computer. Not every economy, not every circumstance, not everybody has a computer in their house, but there is a vast majority that there is, right? And soon probably we can even code it on our own mobile phone, and then you reach out to even bigger amount of population. But I think, again, to me, Web3...
No, Mike's gone.
The Web3 promise is of a decentralized economy. It is of being able to be more equitable, being able to distribute wealth in new ways, and I'm a strong believer of that. That's what I'm doing it for.
We're running out of time, but I do love this question that just popped up about what regulation is necessary to make sure the metaverse platforms don't absolve their responsibility. I know the European Commission this month has already said that they're going to look into the metaverse, not necessarily proposed regulation, but you already have the European Commission's eyes on you. Jeffrey, do you have any comment on regulation you would actually like to see?
I think regulation doesn't provide companies to have good values. You know, regulation always comes after because it takes lots of time to get rules around something that people don't really understand at some point. So I think it's about focusing on the values of, you know, human values that try to replicate them into the world that's coming next. So you need to have, you don't have to abuse of the system. Now we know what's been the major issues that the Web 2 has caused, and the limitations. So we need to be very thoughtful in how we go to the next version of the web with core human values.
Absolutely, and we are out of time, but I do have one quick more ask from the audience. We do have a poll question for you guys, if you use your QR codes to check. What the poll is, which industries will benefit the most from the metaverse? We have gaming, fashion brands, financial services, dating companies. And there are obviously so many more that we hear about. Education as well. Gaming seems to be the biggest one. Fashion number 2. Big gaming fans. Excellent. Well, thank you so much. This is just the start of many, many conversations I'm sure we'll have about the metaverse. So thank you so much.
Thank you.
Please welcome to the stage Jack Howell, CEO of Zurich Global Ventures, and Bloomberg Green's Lauren Keel.
Hi, everyone. Good to see you again. Everybody looks much more awake and engaged since I saw you a couple hours ago. Jack, good to see you as well. Thank you so much for joining us virtually for this.
Good to see you. Thanks for having me.
So we're going to continue on this theme that we just saw about how industries are being disrupted, talking in particular about the insurance industry. So Jack, tell me, how in the insurance industry are you seeing technology and data change the way that you guys are doing your work?
Yeah, I think there are two primary ways that we see technology impacting our industry. One is maybe more of the sort of logical, sort of old school way of thinking about how technology might impact us, allowing us to improve our customer service, digitalizing some of the way we interact with our customers, and really embedding technology in our operations. And I think that's certainly one way we need to think about technology and innovation. But for me, what's more interesting is actually the other way that technology impacts our industry, which is around really changing customer behaviors and expectations. And I think the last session is a good sort of segue into that. If you think about the metaverse, and if people are starting to really, interact within the metaverse, how do insurers, change the way we operate in order to be part of that conversation, to be part of the customer experience? So technology impacts us not only directly in the way we run our business, but also indirectly in how we change our business model to serve our customers.
Can you give us an example of one of those changes?
Yeah, I think, it started with insurance becoming more embedded in the way we operate. So, how do we include insurance in a digital customer journey, for example? And that's something that insurers have been working on for some time. And, when people buy assets online, when you buy a travel ticket online, you don't want to then have to go buy insurance somewhere else, right? So making sure we're embedded, we're in the journey, we're in the experience. I think that's the first thing that's happened. The second thing that's happened is insurance has become much more service-led. So customers are asking their insurers to be more involved, within their asset, not just protecting them or paying them a claim. So for example, with cyber, it's really important for our consumers that we're there from the beginning. We help, assess their situation, understand the potential risks that they may have, help mitigate those risks around cyber, help make sure they're protected as much as possible, monitor the networks, and identify when a breach has happened and help remediate that breach. And often that service component of insurance is becoming far more important than the actual payment itself. Because if you can avoid, actually having the incident, then you're much better off. And I think the third way is we're seeing insurance become much more contextual. And this is where I think it gets much more interesting for insurers, because if we can provide the right information to our insurers at the right time and the right product, then we can be much more effective and much more in tune with what they need. A good example of that would be if we have an insured who's on a travel bike, a motorbike in Southeast Asia, we know that maybe they don't have coverage for being on the motorbike. Can we, reach out to them proactively and say, hey, you don't have coverage for this particular, this journey that you're on today. We can provide it for you, and be more contextual around when they actually need a product and what product they need.
On that theme of contextualization, how are you using that data to really benefit the consumers? So how are you helping them feel like you're looking out for their best interests versus using their data in a way they might be uncomfortable with? And how is that also impacting your business model as well?
Yeah, I think, what it means for us is if we know that the customer is putting themselves in a situation where potentially they might need help, how can we proactively help them to avoid something from happening? So if you have monitors in your house for leak detection, it's not just about getting the data on leak detection so we can pay a claim, but maybe we can predict leak detection, get ahead of it, and make sure the leak doesn't happen in the first place. So there's an element of trust with that data as well to make sure that insurers are using it appropriately. And at Zurich, we take that trust very seriously. But we believe by being in the conversation, by having the data, we can help avoid risk in the first place, which is ultimately what everyone wants to do, make sure it doesn't happen.
Great. And in our last 30 seconds together, how are you seeing the perspectives of your customers change, especially with their increasing use of tech and data? What are they asking from you that's different?
Yeah, I mean, it's amazing to me to see how expectations have changed in the last 20 to 30 years. I just think of a very basic one, going out on the street and trying to hail a cab versus today, you plug your name and location into an app and a car shows up. And I think that, that expectation around speed, that expectation around understanding the actual customer need is translating into insurance very quickly. Customers don't want to buy policies that don't cover them for the risk that they're trying to protect. So really having that data, understanding the policies that are bought, understanding our customer needs allows us to be very specific in those situations.
Fantastic, Jacques. Howell, thank you so much for joining us.
Thank you for having me.
Excited now to share the next episode of Leaders with Lacroix Goes Green, featuring Bloomberg's Francine Lacroix in conversation with Aicha Evans, the CEO of Zoox.
Thank you.
Aicha, thank you so much for joining us on Leaders with Lacroix. Now, Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. First of all, how would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car there's an inference that there is a driver. And in our case, and especially a human driver. And from an engineering standpoint, the architecture of a car is around a human driver. The hood, so that you can see ahead of you, the windshield, even the seating arrangement, so that the people you're transporting do not bother you. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
So is there a piece of technology, Aicha, that you wish you'd have at your hands to make it better, to make it workable
100%? No, time, if I could accelerate through time, that would be fantastic. Look, it's about testing. We can drive, that's not the issue. The issue is, and we follow the rules very well. I always say that when it comes to products that use self-driving technology, there are two metrics that are really important. Safety. We know that in the United States, on average, over 40,000 people lose their lives through car crashes. By the way, the pandemic did not help us. We actually spiked up to over 43,000. And those are mostly caused by the human driver's errors. You know, we're not at times the most disciplined. We're looking on phones. We're maybe a little bit debilitated because of, a couple of glasses of wine, or we're talking to somebody, and that causes errors. But computers are very good at not making those types of errors. There's another statistic that's really important, is that on average in the United States, humans collectively drive 100 million miles before causing a fatality. Just think about it, 100 million miles. And it takes a lot of testing, a lot of statistical math and forecasting to meet and beat that number, because we strive to be better than humans.
So when you focus on safety, Aicha, how much in advance can actually Zoox predict events that are about to happen?
We can predict things. So the way the AI stack works is, first of all, and this goes to our robotaxi and the sensor architecture and compute, it's important to maximize all of your chances to see what is going on around you and in your environment. And this is why our sensor architecture uses camera, LiDARs, radars, and long-wave infrared cameras, so that, for example, we can sense heat and something is alive. This is why we have them at the top 4 corners, so that at any point in time, 3 of those sensor pods are basically seeing you. And then the compute, being able to basically fuse all of that information and data on a continuous basis, and then predict what are the agents around us going to do, potentially, and therefore, how should we react? And we're constantly in that loop. And the better and the faster you can do that, and basically the more will be there. But that's not really the issue we're having with the testing. The issue we're having with the testing is what I call the millions of unique edge cases last minute things that happen that humans basically are very good at dealing with it. I like to say that you've been learning to deal with them as a human ever since you came out of the hospital, basically, as a baby. You're already seeing cars, agents, when do I cross, when don't I cross, all those types of things. So that accumulated knowledge is what computers are not very good at, but we're able to run a certain level of prediction.
But Aicha, what is this concretely? So is this reflexes? Is this, morality issues?
It's things that, for example, another human broke the rule. They came onto your oncoming lane. You could say, hey, you're not supposed to come on my oncoming lane. But the reality is that when your human driver sees somebody else come on their oncoming lane, they assess the situation and quickly either stop, slow down, go around something. It's all of those little mini maneuvers every time something different happens.
So you're not only trying to replicate the human mind, right? And I don't know how long away we are from that. It could be decades. Are you trying to make better decisions than the human mind?
We're trying to make, I don't know that they are better than the human mind, but for a robot, they make a lot of sense. So we're trying to make the kind of parallel applicable decisions so that we're moving people around. And so that means we won't necessarily replicate what a human driver would have done, but we'll make a maneuver or a responding maneuver that makes a lot of sense, is safe, keeps the flow of traffic, and also our customers comfortable.
Actually, I mean, you have such a complex industry that you're dealing with. It's AI, it's regulation, it's of course actually making the vehicle. What would you describe your company as?
We basically are a mobility on demand company from point A to point B, first for human transport. That business model and those businesses exist in the world today. The only difference is that when you're on an app today, whichever app you choose, you say, I want to go from point A to point B. What shows up is a passenger car with a human driver. So that's the business. It exists already. All we're doing is replacing the tool, meaning it's not going to be a passenger car with a human driver. It's going to be a robo-taxi that comes in. It's a more enjoyable experience. It's electric. Yes, it uses self-driving technology to move it, but that's it. So for those who think we're doing everything, we're not. We're doing the Venn diagram of what is necessary to accomplish that goal.
So how far away do you think we're from accomplishing that goal? You're talking about, for example, gathering information, the perception phase, right, which is cameras, radars, infrareds.
And LiDAR. Look, it depends. We tend to be very realistic about what's going on here. This is a beginning of a wave. When you look at all of the big industry transformation, they did not happen overnight. They took quite a while. So in a geofence area, we hope to be out there very soon. Our focus is being on public roads with our robo-taxi soon, but it will be in a moderate, small to moderate scale. And then the question is, our ability to be able to add geofences, to add cities on a continuous basis and in a way that is sort of good for customers, because there's no point in doing it in one tiny little geofence and not being able to go to a bigger geofence, because then the customers will be like, this is a gimmick. When is that coming to me? So it's when the journey begins.
And how do you make sure that people aren't scared, right? We've all seen some of your rivals doing tests that then ended up in people either in hospital or even mortality. So how do you make sure that everyone around the world, or certainly your markets, is comfortable with what's going on?
Look, first of all, internally, safety is foundational. I mean, you will hear about safety at every layer. There isn't a single organization or a single person that is wholly responsible for safety, because we all are. The second thing is you have transparency and metrics, right? And so the bar we hold for ourselves in terms of getting out there is really high. Now, I do believe that the market will naturally speak. Because if you're a company that's out there and you're in too many incidents, you're not transparent, you don't have the metrics, you're not able to explain what happened and what you've done about it, and people are not comfortable, guess what? They just won't use the product. And so I think there will be a natural sort of a natural balancing act there. But for us, it's first we have to convince ourselves through metrics, testing, data, information, and forecasting that we feel we're safe enough for the specific geofence.
So what kind of conversations are you having with regulators? Is that too soon, or do you have to start getting them into the fold right from the start?
Oh, we've been talking to regulators since almost inception. We were a company that hired Mark Rosekind in 2017, when everybody was still just talking about the technology itself. For reference, Mark Rosekind was the last administrator in the NHTSA administrator in the Obama administration. He has a lot of wisdom. He's been in the industry of safety forever. And so we've been talking to city, state and federal folks since inception. We hold events, we have conversations, we provide data, we also ask for advice, we also educate. It's an ongoing dialogue, and I expect that to go on forever.
Now, when you focus on green or sustainability, how do you think this will change cities?
So, I think it will improve things dramatically. The fleet will be, or is, fully electric. That's a good thing. Second of all, today, humans, when we buy a car, we actually only use it 4% of the time. The rest of the time, it's parking either in our garage or in somebody else's garage or in the street and taking time. And so just from a mathematical standpoint, we're building more things than we need strictly for human transport. So we will make less things, because when you're not using the robotaxi, somebody else is using it. So it's very effective and efficient. Now, I call it an improvement because we as an industry, and I mean overall, there needs to be a lot of improvement in the battery ecosystem, whether it's batteries themselves, whether it's the making of them, the using of them, as well as what happens on the end of life of a battery. And I believe that there's still a lot of work to do, but I think there'll be a lot of innovation in that space.
When do you think we'll have the first self-driving robotaxi in a big city that's also very eco-friendly?
It's going to be, I don't know, we don't get into dates at Zoox because we feel that it's better to show and then tell than the opposite. As an industry, and I'm saying an industry, meaning us, everyone included, we've made too many, it will happen. We've kind of like been either, oh my gosh, it's going to happen tomorrow morning. Oh my gosh, it's never going to happen. So we don't really get into the dates, but within definitely a more realistic time frame that maybe some people are quoting out there, there will be cities. I mean, testing has started for all of us. And so I think it's much sooner than people realize. The question will be the game of then replicating that to several cities, to an entire country, and then to several countries.
Were you frustrated, or are you frustrated now? When you started, did you think it would be quicker to have these self-driving robotaxis, or slower?
You're going to out me. That's not nice. I actually think it's going about, I thought it would be even slightly slower. Even the ecosystem of driving, right, or with passenger cars, from horse and buggy and all of the infrastructure that comes around it to where we are today, it took a little bit of while, right? And so I actually think that it's going at the correct pace. It's slightly slower maybe than I expected, but it's about the pace. This is a big deal. This is a hard technology, and this is a societal transformation.
At the same time, we talk a lot about this environmental transformation maybe taking longer than we were expecting because of some components not being readily available. Do you worry for the car industry, for the industry you're in, that we just don't have the right components for the battery or for the self-driving vehicles?
I think we have the right component at this point in time. The question is, how are we going to stimulate the industry, academia, research, governments, regulatory, to pour a lot into this space? It's not just about having mandates. By 2000X, all cars will be XYZ. There's a whole infrastructure across all of the different vectors, including academia and research, that also has to come with us so that we have enough innovation for the scale that's going to be necessary.
And how you change people's perceptions. I imagine that you're worried that in certain countries, people won't want to give up their cars.
Well, yes. I mean, disruption is always interesting. There are a lot of countries whose economies depend on the car industry. And so I do worry about that. But I think that one of the mistakes maybe we've made in times of disruption is to not have engineering empathy for either the company or the country that's being disrupted. I think it's better to have conversations now, figure out how we manage through the transition together as opposed to good or bad. Because one thing we know about humanity and our history is that progress is unstoppable. I like to say sometimes for effect that if you could wake up somebody who died 2,000 years ago magically, and then drop them in the middle of New York City or Mumbai or Cape Town, they literally couldn't function. They wouldn't know what to do. And so I think that we need to be generous with each other and manage through the transition together, but understand that this is unstoppable and inevitable.
Yeah, even someone who passed maybe 100 years ago would be completely lost in New York City.
Exactly. They would be looking for the stable and the buggy and the coach and be like, no, 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 you need to either buy a car, take the subway, take public transportation, or call, a mobility.
And always look at your phone.
Company. And by the way, where's your phone? No, no, we don't mean this phone. We need a phone that's a computer in your pocket. Do you know what an app is? So yes, that's why I think that we just need to be patient and drive through the transition together.
But actually, if we look at the last, let's say 20, 30 years, it's amazing the pace of change and how quick that was in the last 6 to 7 years. Can we replicate that again?
Oh, I'm confident we can. Look, prior to being in this industry, I was in the wireless industry, had a lot of fun with that. From, people forget, even the landline was an evolution, right? It used to be switchboards and an operator needed to be on the other end of that. And then from there, we went to cell phones. I remember being in a lab when we received the first text string on an LCD screen through GPRS and Edge. But then we were already working in research on LTE and basically Wi-Fi and all these things. And we were dreaming of people having the internet in their pocket and what that would enable. By the way, we didn't really think about apps or anything like that, but we just trusted that with the availability of the infrastructure, people would innovate on top of that. And boy, did they. And I expect the exact same thing to happen in the self-driving space.
What's it like being part of the Amazon family? Do you get much exposure to Jeff Bezos?
I get this question a lot. It's pretty funny. Yeah. Look, I mean, first of all, we love being inside Amazon. We literally are grateful and privileged because this takes a lot of capital. There are a lot of really good success stories and also good learnings at Amazon about being long-term oriented and being part of creating a new industry and driving, to use a cliche, transformation. So we get a lot of good advice. It's been really great. And no, I don't hang out with Bezos and Jassy and Limp. And I mean, this is a job. They want us to get to market. They want us to make the progress we say we're going to make. They want us to build a great company. And that's really the basis of the relationship.
Did you always think you'd get here when you were growing up? You were always, from my understanding, very passionate about science and technology.
When you're a kid, it's funny. I wish I could get a redo because, man, I would be a lot more chilled. I knew I wanted to study and be in the field of science and technology. I knew I wanted to match it and mix it with what enabled things for humanity and society across all continents. But exactly what form that would take and whether I was going to make it, I often think about, when something bad happens to a human, I often think about, well, why them and not me? So no, I was a lot more stressed out about, isn't going to work out, then am I going to be exactly here? But I'm privileged and happy to be here. I feel blessed.
Is that the kind of advice that you give to, if someone very young were to come and see you and say, like, I don't know what the jobs of tomorrow, what the future brings, what should I study at university? What would you tell them?
So first, I always tell people, spend a lot of time with yourself. The longest relationship you're going to have in life is with yourself. Understand who you are. I can tell you that I don't know that I fully understand Aicha yet, but there are a lot of things I understand. Simple example, Aicha likes disruption. So do not put Aicha in charge of something that doesn't need to be disrupted because she'll mess it up. And that doesn't make me good or bad. It just makes me different. So spend a lot of time with yourself. Second thing is understand your passions, because if something doesn't feel like work, it feels it, you love it. I know that's a cliche. Then you'll be able to go through the ups and downs of it, and you'll be able to evolve with it. Third, I believe that the blend is the most important thing right now. I think not understanding technology at all is going to make it difficult if you want to be in that field or in sort of the field that drive things. But understanding empathy and humanity and blending technology with that is where it's at. I mean, AI is all about that at the end of the day.
So you'd go to, study maths and anthropology?
That would work very well, actually. I wish I could convince people to do more of that.
Ajay, talk to me a little bit. If you had to choose between sustainability, right? If you look at Zoox, so it's sustainable, it's green, but this very advanced technology for driverless. If you had to choose between the two, which one would you choose?
It's a non-choice. They have to advance together. Now, we can make some compromises short-term versus medium-term versus long-term, but it has to go together. I mean, sustainability, and that's one of the things that's a little bit of a pet peeve of mine. It's not just about electrifying. That's not what sustainability is. More and more people are coming up the economic social strata. They want to do stuff like everybody else. They want to have access to knowledge, good lives, shop, and so on. And the infrastructure is saturated, and we need to think about things holistically when it comes to sustainability, not just electrification, but it doesn't have to happen overnight, though we need to get going.
It feels it's always American companies that get there quicker, get there better with more funding and become bigger and more successful.
Well, oh, come on. Maybe at times, but first of all, a lot of stuff is happening in China. I do think that China has a thriving self-driving ecosystem and also is almost engineering its way through innovation. Look, I think that let's be kind to Europe and the rest of the world. For example, in wireless, there was a lot of innovation there. I think that it's important for each one of these ecosystems and countries to look at their value system and how their economies and societies work and push for innovation. I can tell you that, and this is not a plug, it just happened to be, I am an advisor for Balderton Capital, which is a VC firm in Europe. And I chose that specifically because they are working with the entrepreneurial ecosystem in Europe. And I think it's important because I think there's something structural about what America does with its universities, with the VC ecosystem, with government, even something like DARPA. That's actually something that others can replicate.
But at which stage? So you think it's structural at university in actually taking a chance in, I guess, failing and not being bothered by it? Or is it actually at the funding stage?
Oh, I think it's sooner than university. I'm going to tell you a story. I still refuse to write in French these days. I speak French very well, fluently, because I am still traumatized by the red pen correcting my spelling mistakes and the shame that came with it, as opposed to the willingness to learn more. I think that what the US does really well is, in my humble view, I hope I don't catch too much flack for it, but it's a learning culture. And it's not I mean, yes, there's judge and jury, there's privilege and all those things, but there's a lot of learning that's built in. And I think that others could benefit from it. The second thing is at the funding stage, encouraging innovation. There are we talk about all the successes in America. There are a lot of failures too, but they don't stop or slow down the progress. And then, yes, of course, you do need money and the flow of it.
So what kind of leader are you?
An evolving leader, a learning leader. I place a lot of focus on people. At the end of the day, my job is to serve the people so that we can reach the goal. I can't do anything by myself. I already know what I think. And so what's more important is how do I enable others? How do I understand why they think the way they do? And how do we get to the same goal? I think that I'm a little bit of a control freak, but I'm in rehabilitation. I've been on it for 15 years. That's probably the thing that's the hardest. And it manifests itself usually on Fridays at 5 p.m. And so everybody at Zoox knows that if you're going to schedule a difficult meeting on Friday at 5 p.m., you might need to manage through Aicha, because I'm just exhausted by that time. And my ability to control myself is not as effective.
Do you remember the hardest day in your career, and what did you learn from it?
Oh, I've had plenty of hard days. Yeah, I mean, one hard day was at Intel. I was in a very, very, very difficult meeting and situation. I was angry coming out of that meeting, and I will always be grateful to Stacy Smith. He was the CFO back then. He gave me a call and he said, "How are you feeling?" I said, "Not good." I used choice words. And I'm going to do this, that, and the other. And he basically said, "Look, first of all, I hear you. I understand why you feel that way. Why don't we do this? If Monday morning you still feel like sending that email, then send it. But hold it in your inbox until Monday." And needless to say, I didn't send it Monday. I learned a lot from that. Sponsorship, generosity, being proactive, managing your triggers, and so on. I would say that I've had some tough Zoox moments, especially around choosing what to do long term, but stay true to your principle and play the long game, not the short game. Because with Zoox, if we had chosen the short game, it would have been not good for the company in the long run.
Aicha, thank you so much for joining us today.
Francine, my pleasure. Thank you.
Innovation, innovation, innovation. It's on the tip of everyone's tongue. That quest has only accelerated through the centuries, and it seems to be at the heart of virtually everything we do.
For Zurich, innovation is a great opportunity that we took to give customers new services, new means of contact, and new opportunities.
Collaboration, iteration, aggregation.
We need curiosity, creativity, and agility.
Be part of our future. Join us. Let's make it happen.
Please welcome to the stage Edward Cooper, Head of Crypto at Revolut, and Irina Haivas, Partner at Atomico, with Bloomberg's Emily Nicole.
Hello, everyone. Well, welcome to our session on crypto. This is our one session on crypto for the day. I feel like it's obligatory at this point at a tech conference, but got to have at least one. So over the last year, I think crypto's been on a pretty wild ride, and that includes inside the realm of technology. We've seen prices go up, Web3 became a thing, NFTs became a thing, but this year has been quite a different story. So seemingly, every investor and shareholder a year ago was probably having conversations with tech companies asking, where is your crypto strategy last year? These days, not so much. So besides falling prices, Irina, why do you think that is?
Well, I think the macroeconomic environment has an impact on technology overall, Web 2 and Web 3 included. So that's, crypto is not kind of protected from that. I think we've also seen, obviously, specifically, in crypto, some of the events, like the prices going down. But I think it is actually a lot of it is macro. I also think it's a reaction to the fact that last year a lot of the growth was, some of the growth was real and sustainable, and some was speculation driven. And that always kind of comes to an end at some point. And so a lot of the tourists in the industry are leaving or have left, people that were trying to take advantage of basically making a quick return on their investment, but not actually being fundamentally invested in the space. So that's the other factor. But actually, a lot of it is macro. Then there's particular aspects related to crypto around regulation and so on. But I think the kind of shock to the system came a lot from the macro environment.
And also at Revolut, Ed, you have got a nice insight into what I guess the consumer would make of such products. You guys offer crypto trading as a bank as well. So what have you seen over the last year? What trends have you noticed as we went from bull to bear market with crypto?
Yeah, sure. I mean, we've actually been involved in the crypto space. We started talking about it in 2015, and we prototyped a product in 2016. So we've always had this belief in the future of crypto. But what have we seen? So, you know, we went through the whole 2017 bull market, and like from a retail perspective, of course, like trading volumes go up loads when people are super interested in just the price, and then it drops after that. But I think if you look at the 2013 bull run, 2017 bull run, and then 2021, what you tend to see is like a lot of euphoria. So then there's a lot of funding, and a lot of companies get formed, some of which have got good business models, some of which don't. Right? Then the tide goes out, and the ones which actually had a genuinely good business model or a good idea for the future or were able to pivot, they're the ones that survive. And actually, the kind of bear market helps them because it acts as a forcing function to structure their business to be extremely efficient and to be hyper-focused on adding value for users, whether it be retail or business. Right? So when the next bull market comes, they're now in a very strong position, and it's when you see the big crypto companies that emerged in 2017, and I think then you saw the same 2018, 2019, people were building. The ones that didn't have a viable business model, they died out, which is helpful. And then 2020, again, it's very frothy. Loads of people come in, possibly, again, not really a viable business model, but everyone's euphoric, and the same sort of cycle happens again. But I think as we saw with the .com boom, then bust, you actually saw some of the mega companies were created in that time when the froth had gone away. And I think it was the same thing. It acts as a forcing function to just be hyper-focused on making your business super efficient and adding value. And then as the market improves, you've got a potentially well-beaten company.
And what about as a customer function as well? So in terms of your users, people buying crypto on your platform, trading it, selling it, how have you seen that ebb and flow over the last year?
Yeah, so kind of the same story. 2017, then 2018, and then pre and post this current bull market. Like when we released crypto, pre and post us releasing crypto, we saw a step change in the amount of users signing up to the platform. Now, as the crypto market dropped in 2018, obviously users were trading less, but we never saw a return back to the previous user sign-ups, i.e. low. They remained elevated, which was interesting. And I think we've seen the same now. Like, yes, people's trading volume has gone down, but we're actually seeing an increased interest in crypto, and the amount of people signing up, so new active people, on the Revolut platform is actually much higher than it was like early 2020 versus now. So I think that just shows that while of course it's like highly correlated with people are interested in the price and stuff, it's kind of getting into people's consciousness more and more as it becomes like a mainstream asset, and people are just more interested in getting involved and learning about it.
But Irina, also on that, I guess it's now a mainstream asset, sure, but a lot of people have been burned by the downside of crypto, companies and consumers alike. How have you kind of experienced that through your investing as a VC?
I think, so kind of like, I guess to step back and think of what is our underlying thesis on the space. We are believers in this being a trend that is here to stay and that is transformational for the tech world. We had mobile, cloud, other technologies that people were skeptical about that had their rise and fall moments. I think what's happening is like, even if there's a fall, so to say, underneath it, there's actually what Edward was saying, actually a slow maturation of the technology, adoption of the use cases that are most relevant. There are, of course, a lot of things that still need to happen, which is actually need to happen, which is where we see opportunity from an investing perspective. If you think, for instance, if you take kind of like the picks and shovels of building in Web3, right, this sort of like Web3 infrastructure, it's still in its early days. Like the levels of abstraction that a developer works with in Web3 now, it's probably the level of abstraction that a Web2 developer worked with 20 years ago. Like 20 years ago, I couldn't go to an 8-week coding course and start coding. Now I can, because there is that infrastructure which allows a wider range of developers and of people to kind of like enter the ecosystem. So the way we will drive adoption is not only by more people kind of like wanting to do the hard work and learn, but it's also by making it easier. And then on the consumer side, from a consumer experience perspective, I don't know anyone that has bought an NFT and has a MetaMask or a Quant. The amount of times you get a like heart attack for where is my NFT, doesn't show up anywhere, and it's just a whole experience of trading and even simple actually currencies, right? Without thinking of other products. It's not for everyone. There's like still a lot of friction that kind of like the for mass adoption to happen, we need to improve that user experience. And then lastly, another area of opportunity is, I think, or of kind of a potential driver for this ecosystem is around enterprises starting to adopt some of the Web3 technologies and embedding them in their business model. So if you take NFTs, which is this essentially a technology enabler for digital ownership that got bad press for, you know, the CryptoPunks, price fluctuations and so on, but people are kind of equating a technology with a use case, which is not true. Like NFTs can enable digital ownership in a lot of other use cases, in gaming, in social media, and you can see already, you know, Instagram embedding digital collectibles and NFTs in their business model as a way to help creator monetization, which is one of the things they're trying to solve, or Starbucks using NFTs, you know, not just kind of like as a way to trade, but also actually as a gateway to access rewards and experiences. So even this technology, you know, has still very, very infancy, and it's going to move from like there's still room for it to develop into a store of value and into gateway, and then later into an asset that you could trade on a Revolut platform, right? So those fundamental use cases and technologies are still there. In a way, for us, it's actually not bad that the hype has gone a little bit out, because it means that the people that are going to come and build in this time are one, aware of the market conditions, and they're also like building for their believers, and they want to build something more sustainable rather than speculate around it.
And that kind of brings us on to the live question that we're going to run today, which is about, you know, should tech companies be considering adopting blockchain technologies in their stack, you know, and we have several options. You guys can all vote. I think you know the procedure by now, but you know, yes, it's the future. Maybe if the volatility subsides, and no, there's no need for them. And we also do have audience Q&A throughout, and we have had one question that was about, you know, is this tech just too immature? You mentioned Starbucks, you mentioned Instagram. These are all really big technology companies coming out with crypto Web3 products. But as you said, the technology itself is still very difficult to use, still very difficult to implement. And Ed, at Revolut, I know you've been thinking about ways in which you could adopt these technologies internally. So if you could tell us a bit more about that. Yeah, sure. I mean, that large question about whether tech companies should implement blockchain, I think the answer is like a resounding 100%. And the reason for that is the structure of the blockchain and the nature of the network is extremely similar to the internet. So what I mean by that is it's a very simple network where you push all the innovation out to the edges, right? So basically the innovation happens by people able to release products and services in a permissionless way. So on the internet, when that started, no one could predict like this exponential curve that would happen, because it was just, you know, email, very simple, or like a bulletin board system. But the nature of the network meant that anyone with an idea could essentially iterate at the edge of the network, then release it, and then if the network found value in it, suddenly you've got a billion-dollar company like Google, for example. Okay, so, and then that leads to other companies being built on top of those tools and services. So when we were here, everyone was kind of skeptical about the internet as the same thing. Oh, it's not very secure, it's immature tech. But you're at the knee of this exponential curve. So blockchain is exactly the same. It's actually a very simple network for finance and other things, and you push all the innovation out to the edges. So previously, to innovate in finance, extremely difficult closed-loop systems. Now, anyone with an internet connection can actually create a financial tool or service on many of the different blockchains and just release it in a permissionless manner, and then other people can plug into that. So it's exactly the same nature. I think we're on the knee of this exponential curve. So the question becomes, you know, who do you want to be? Do you want to be like Borders Books, or do you want to be Amazon? Do you want to be Blockbuster, or do you want to be Netflix? I think if you're not looking at blockchain strategy now, you might be in trouble in the future. And to go to that point about NFTs, see, NFTs, you know,
everyone's been talking about them in terms of like art and the monkey JPEGs. They're not about art. It's about digital ownership, right? It's about this digital token that can confer real-world value. So I'm thinking about NFTs that are used as tickets. So Gary Vaynerchuk, for example, has released a very successful NFT strategy where if you own his NFTs, it gives you value in his ecosystem. So it's tickets to his events, it's discounts, it's all these kind of things. If I was Ticketmaster right now, I'd be starting to get worried because there are hungry startups all waiting to eat Ticketmaster's lunch, and NFTs provide them a way of doing that. So yeah, my answer would be 100%, you need to start looking at it.
But one of the things that is a downside of blockchain is the question of interoperability, right? We had a speech even today from the Bank of England Deputy Governor, John Connell, who said, you know, interoperability in blockchain is one of the biggest problems and issues that banks face in considering to implement it, because you might find products and markets just get totally siloed on their own. How do you find that is with the portfolio companies you work with? You know, is it a really big issue for them that they might set up something on one blockchain and then it just totally isn't transferable somewhere else?
It is an issue. At the same time, we're probably at a stage where you'll have consolidation across. There are a few kind of emerging, you know, ecosystems, so to say, layer ones that are becoming somewhat dominant, right? And Ethereum is a very large and thriving ecosystem. So you can solve that problem by essentially choosing less of them and still cover a big percentage of the market. The problem is around scalability and interoperability. It goes back to my point around the infrastructure is still being built. It's not just interoperability, there's also like privacy, there's kind of all the basic challenges. At the same time, it doesn't mean that, you know, in my view, to that early question around should companies adopt blockchain, I think it actually depends on what problem you're trying to solve and what can it do for your business. And in some cases, there is a more immediate need to adopt it because you may be disrupted or because it actually can provide, you know, like a creator monetization. You know, it's been a big issue in some of the social media businesses. And so it actually can accelerate your business model. So for those, it's more imperative. There are many, you know, if you think about more traditional enterprises and adopting, you know, NFTs as a kind of an identity verifier and other, you know, supply chain, other kind of use cases, those are probably further away. Maybe you don't need them right now. Maybe you're going to wait for the technology to be more advanced. But definitely in some of the, you know, social media, entertainment, those spaces, I think you kind of have to be watching. And there are companies that are being built that are essentially starting to provide those layers of abstraction. We invested in one, but there's a few others, and there are already, which are removing this need for like do-it-yourself. Like you have to hire an army of people and build your own tools from scratch. You still need to hire, but at least hopefully there will be companies building these picks and shovels that you can then adopt, and that's also going to drive and make it easier for enterprises. It's not that dissimilar from what happened. It's a kind of a normal technology adoption, right? If you think about a lot of other solutions that enterprise uses, at the beginning they were doing it themselves, and then a product came out, and you know, we were talking about the intranet and the Slack, right? That people were building their own Slack before Slack existed, and then they started buying Slack, right? So it's the same type of curve.
Yeah, sure. Although, you know, when building your own stack or using your own stack, that's pretty much still a very safe, regulated area, and
yes.
Crypto comes with its own sets of risks. So how are you guys also thinking about that? Like at Revolut, for example, you guys are a regulated business. You just got registration yesterday, I believe, with the Financial Conduct Authority. So how do you think a lot more about the risks of crypto and how customers need to be protected or can be protected even from these things?
Yeah, it's extremely important. And having started our Revolut crypto journey way back in 2015, we know how challenging it can be, which is why actually increased regulation in the space helps a lot. Because what we found, we started discussing it in 2015 because a few of us at Revolut had been in the crypto space since 2013. But when we started kind of just testing the waters with partners in 2015 with kind of prototypes and things like this, there was no appetite whatsoever. It was just very easy to say no because there was no kind of regulatory landscape where they could assess the risk even. So it was just this unknown quantity. then gradually fast forward to 2017, regulation had improved, the tools had improved, and we managed to get partners comfortable with kind of like a quite walled garden crypto approach. And what we found is, as more regulation comes in, we're finding more traditional partners are actually more interested in talking to us and partnering us, with crypto. I remember after we launched crypto in 2017, we were trying to do expansion into various different like European countries with various different products. And the business team kept on coming back to me and saying, please, let's turn off crypto because, so-and-so bank don't want to work with us, even though they're not even involved in the crypto flow whatsoever. It was a purely reputational risk for them, or that they perceived. But we pushed ahead because our view is that this will act as a forcing function to structure our business in such a way that we select more crypto-friendly partners so that as the crypto space evolves, we can evolve our business as well. And then regulation has come in. That's made it much easier for us to find new partners. And in terms of customer harm, yeah, of course, like all these directives that are coming in now about more careful way of communicating to customers. We've always actually done that ourselves. We treat crypto the same way we treat our regulated products. So when we do communications, we use the kind of same amount of care. I think in the crypto space historically, you can't say that's been true of everyone. Like there's been some pretty crazy stuff I've seen on the tube and the buses. But I think now that's improving, and that's very important because it is highly volatile. It's still quite speculative if you're just a user trading these assets. So yeah, protecting the consumer. I'm glad now that this is starting to come into the kind of regulatory overview, and I think it's good for the space. Yeah.
Yeah, because one of the questions I was going to ask you, but I feel like you answered it there, was about, would tech companies be daunted by the regulatory wave of stuff that's about to hit us with crypto? And, if you wanted to implement crypto or blockchain in your business, should you be scared by that kind of regulation coming? But we did have a result with the live poll. About 60% of people agreed with you that, yes, blockchain is the future. So perhaps they're already braced for it. To move on from that, though. Hear me? Oh, okay, there we go, back. So with Web3 funding in particular and venture capital, a lot of VCs raised a lot of money for Web3 last year as part of all that hype drive. And those funds now are looking for places to still deploy that capital, even in a bear market. We can see, if we look at a chart of it, it's just popped up, that funding rates are still really, really high. You guys are still deploying capital into companies even when prices are low. Why do you think that is? And is it just a case of this money having to find somewhere to go, even if, the bets aren't the most promising?
I think it's what I said at the beginning, a fundamental belief in the technology and for the long term, right? If you think about the investments we make today, we come in really early at seed or Series A, and then generally we stay with a company for 7-8 years. So you normally kind of have to take a view on what you think the world will look like in 7-8 years from now. And therefore, what kind of like happened today is not, as I said from the beginning, it's actually, in some ways it's better because this whole speculation and hype is gone, but there are a lot of areas to build in Web3, and that are not even, that just people are just scratching the surface. And so there's a lot of ideas, there's a lot of white spaces, there's a lot of like pain points that drive adoption, and that's what drives all of these funds to keep investing. And there are people like going still into the sector. There's a lot of Web2 developers wanting to be Web3 developers, and people that come from outside of the Web3 that want to join Web3 businesses. And it's still hard to recruit in this space because there's competition and there's not enough talent. So there's kind of like there are positive signs underneath, and I think that's the view that investors are taking at early stages.
Well, yeah, so to pick up on the talent side of this as well, we've had a lot of crypto companies this year. Even the biggest ones have had to cut jobs, say we need to constrain on costs. So there is some kind of capital crunch going on here. But Ed, I know we discussed previously about how actually in this case is like tech companies, traditional companies, banks, they can all be safe spaces for those kinds of talents. Like, are you finding that more crypto talent is coming to you from, you know, a Web3 startup or a DAO who have said they've just lost their job because this tiny company can't support them anymore, and so actually doing it for you inside of a very, very large company is a safer place to be?
Yeah, I think that's a really good question, and it is a good point. You know, when the euphoria is there and the frost's there, I mean, what do people want? They want to kind of feel like they're making an impact and also potentially have like big upside. So when kind of everyone's euphoric, people will take a lot more risk. And I think you're absolutely right. When the euphoria goes away, people still want to have that impact, right? And they still want to be working on the cutting edge technology, but they might be a bit more risk averse because all the macro stuff that's happening. And so then if you're looking around, okay, what companies have kind of proved that they can weather the storm, but they're also working on like interesting technologies. Yeah, it definitely has helped us because we've got a big crypto drive going on at Revolut because we believe in the technology, and we've increased our crypto headcount from like 8 people to 200 people. And so I think for someone who's thinking about switching jobs, and we have seen this, it's, yeah, Revolut kind of proved that it could weather the storm of coronavirus because we've got a really diversified set of products. We're working really hard to push crypto forward. So someone will still get those things that they want whilst taking less risk than if they join like a super early crypto startup now, which still could be a good option for some people, but I think most people are a bit more risk averse than that.
And in that way, do you think that crypto and tech are similar in that? I know you previously mentioned, you know, the 30% failure rate of bets that you make, and you know, some tech companies are failing just the same way that crypto companies are.
Yeah, I mean, is the question around talent or just more generally?
In general with talent as well, but you know, in the current environment.
I think, well, I think there's a general point in tech, which is a lot of the companies, there was a lot of funding, there was a bull market, so it was quite easy to raise funding, therefore generally companies didn't fail that much, and even the companies that may have not found good business models were still managing to fundraise and survive. What's obviously happening now in every sector of tech, crypto or non-crypto, is that you do have to have have a sustainable business model, or at least have a plan to get there. And some companies that have raised, if they haven't managed to prove that, they probably won't be able to raise, and there will be higher. I expect it to be a higher failure rate among the whole tech ecosystem, not just Web3, and that will, of course, drive talent. I mean, there's like different views around here, right? You could argue that keeping alive a company that's not going to go anywhere keeps also that talent trapped. And by, in a way, releasing it earlier, that talent, including the founders, can actually go and build second, third time and be successful. So while last year's there were companies that just kind of like stayed alive without being necessarily on a path to greatness. So I think that's what we will expect to see. That's what we've seen in other cycles, and that's probably going to happen this time as well.
Yeah, and just to end on an audience question as well, we've had quite a few about sustainability. Yeah. Is that something that you guys think about with blockchain these days? Just to quickly wrap it up with this at the end.
Yeah, I think it's a topic that comes up all the time. I think there's, for example, Bitcoin. Everyone's saying it uses lots of energy, therefore that is bad. I think, you know, again, to sort of go back to parallels with previous technologies, there was that famous clipping from way back when about PCs, and it's PCs are going to end the world as we know it because they're bad for the environment. I think you have to separate use of energy and where the energy comes from, right? And like, I don't want to pull the wrong percentage out of the air, but I believe it was over 40% when they surveyed Bitcoin miners use renewables, right? And so that is not a bad thing. And actually, crypto there can actually incentivize a drive towards renewables. So renewables, traditionally kind of lumpy supply-demand curves, that can be smoothed out with Bitcoin mining. I mean, an ex-Revolut person has now gone on to start a renewable energy company, and one of the ways they're going to smooth out demand is by Bitcoin mining. So I think you have to separate the fact that it uses energy, as do washing machines, as do Christmas lights, both of which consume far more energy than the Bitcoin network. You have to separate that from where is the energy coming from, because that's the thing that matters. And all good, useful things in the world use energy, and so then the important thing is where does that come from? And I think if Bitcoin, if crypto can actually incentivize a change to renewable energy, which clearly it can, looking at the startups that are happening now in the climate tech space, that's a good thing.
Yeah, well, we'll leave it there, but I'm sure you've just triggered a very large discussion online about whether this is a good use of energy or not. But right, thank you for joining me, and thanks for a good panel.
Thank you.
Please welcome back to the stage Brad Stone, author and senior executive editor for technology at Bloomberg.
It starts in a few minutes, and we will see you all back here at 1:40. It is, and that's my water. Thank you. Okay.